what continues to drive the market higher here is the tech and the AI narrative.
We are starting to enter the middle game of AI.
It's not bubble-ish valuation.
This is an AI revolution.
The underlying inertia right now looks like it's pretty set to continue for the foreseeable future.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday, the bond market looking for an anchor. Global bonds breaking down, sending yields to multi-decade highs. Tension in the Middle East underpinning the outlook for higher prices, leaving Wall Street beginning to question just how long the Kevin Warsh Fed can avoid tightening policy.
This is what Ed Yardeni was talking about over the weekend in a note where he came out and said if the Fed avoids eliminating the easing bias that they currently have with respect to policy, investors will conclude that the central bank is falling behind the inflation curve and will demand a higher inflation risk premium. A question I have this morning is how much is that already being baked in? The idea that Kevin Warsh is going to come in and be dovish, and right now we're seeing the bond vigilantes getting really excited, sharpening their knives and saying, let's have a crack at this one.
It felt a bit unhinged at times over the last couple of days, particularly overnight in Japan. At one point, the long end of the Japanese curve with a move of 20 basis points. That's a struggle. Japan's got its own problems. The global bond market has got a lot of problems right now across the UK, Japan, Germany, the US too.
Part of the problem is exactly the Kevin Warsh issue is something global. We don't have a sense of how much determination there will be by monetary policymakers to take the pain, to hike rates. This is a concerning moment where you have potential threats to growth at the same time that you have inflation. And right now, the political pressure is to emphasize growth, is to emphasize fiscal stimulus, is to emphasize trying to make things better through the delivery of something, not necessarily the taking away of something. And that is the reason why people are pushing back.
Well, when it comes to the politics of this, the president actually might give Kevin Warsh some more time. Just hours ago, Fortune released an interview they had with the president. They sat with him the day that Kevin Warsh had a key hurdle that he was able to get over in terms of the Senate. And they said with rising oil costs from the Iran war driving up inflation, the president seemed resigned to the fact that it may have to wait for more cuts. Quote, you can't really look at the figures until the war is over. Is he giving Kevin Warsh some more space and time before he puts some pressure on him to cut rates?
That's where the problems start. In the energy market, you see it in crude again this morning. Brent and WTI, Brent around 110. The move in crude fueling inflation and the outlook for higher prices. That's raising questions about fiscal space, highlighting issues around leadership in places like the UK, and leaving central bankers confronting the prospect of hiking interest rates. I tell you, things have changed. A month or so ago, we had people in fixed income come on the programme and say, we're creating value in the yield curve. I'm interested in the belly of the curve. I'm interested in tens, maybe even going further out along the yield curve. 6 weeks later, I don't hear that at all. 6 weeks ago, this market refused to internalise the prospect of higher interest rates further down the road. Things have changed a lot in 6 to 8 weeks.
What's changed is 80 days. That is the number of days that this conflict has been going on between the U.S. and Iran, and the Strait of Hormuz has been closed for that duration. Now the question is it better that we're in a ceasefire? There's no escalate to de-escalate, and there isn't the appetite to do that. So we're just in this quagmire where you're not seeing traffic go through. At what point do people start seeing the step change in terms of just the pure supplies of oil that start to really pressure prices in a more material way?
Brent crude 110, WTI this morning around 106. Coming up this hour, we'll catch up with Rowe of Citi as equities extend losses, Terry Haines of Pangaea Policy as President Trump warns the clock is ticking for Iran, and Berro of JP Morgan Asset Management as bond yields test multi-decade highs. We'll begin this hour with higher bond yields putting pressure on equities. Rowe of Citi maintaining an S&P year-end target of 7,700, writing this on the bond market and fixed income. The market is now pricing in about 35 basis points of rate hikes, which seems challenging to realise as the recent dissenters will not be voters in 2027. Rob joins us now for more. Rob, good morning. Good to see you.
Good morning.
We got a lot to work through. Let's start with the bar for rate hikes. How high is the bar for rate hikes at this Federal Reserve?
You know, I actually think that we've seen a cautionary tale with the central banks. We would be hesitant to be raising rates here because you're facing a more stagflationary scenario. When inflation is demand-driven, that might be a motivation to raise rates. It's hard to raise rates here right now. We do think, though, that the narrative on inflation will continue into probably June or into the summer, and that inflation will continue to tick higher, which will put pressure on the central banks to raise rates. Mind you, the U.S. has a dual mandate, which I think is an advantage here, especially if we think that we'll see a more softening of employment, and we'll see higher unemployment going into the summer.
Well, let's get to that word you used, stagflation. So we've seen tons of inflation in the energy market, CPI, PPI, struggling to find a stag right now. Where do you see it?
Yeah. Well, there is growth in certain parts of the economy, but when you see ag prices going up too, and we see other prices going up and they're driven, you're starting to see a slowdown in other areas and other sectors.
Is the bond market pricing in a reacceleration, essentially, that the stock market is also banking on? In other words, are they setting the same story, which isn't one of stagflation, but just inflation?
Inflation. The bond market, I think, is definitely the narrative is driven by inflation right now, and I think that will continue for the next couple of months. We have a bullish call on oil right now that's probably around 120, so at least for the next 0 to 3 months. If that were to continue into the second half of the year, then we would have to start to ratchet down our call on global economic growth and also U.S. economic growth.
So can you square $120 oil with your 7,700 call for the S&P at year end, paired with a 3.75% 10-year at the end of the year, even though you have inflation that seems to be predicated on where oil prices are?
Right. I mean, get ready, because we think there'll still be 3 Fed cuts at the end of the year.
Yeah, I'm trying to wrap my head around that right now.
We think that unemployment will pick up in the later half of the year. Certainly, if inflation gets higher, that will be an even worse situation for the economy. And that's why you would start to see more of a downturn and a pull away into more the market pricing in cuts instead of hikes going forward. So if you think about oil being up that high, we already ratcheted down our growth forecast on global economy to about 2.6%. That could go as low as 2 to 1.5% if we saw $120 a barrel continuous into the second half, especially with the U.S. We would have to ratchet up our inflation expectations to about 3.4% for the year. Now, with the equity markets and the 7,700 call, what we are seeing is the AI momentum continues to move forward. We're still seeing very strong earnings. We're seeing a bifurcated S&P 500 for sure. So we're seeing a very strong AI-driven growth. PEG ratios still remain relatively reasonably valued, so we don't think that they're priced too high. But on the other hand, some of the other sectors are starting to get affected by inflation.
Do you need to rethink 3 cuts this year, given the fact that even the president is conceding that Kevin Warsh might have a little bit of a harder time convincing this deliberative body to take that move?
Well, my song on my wedding was "What a Difference a Day Makes," and so I think when we get to the second half of the year, you never know what you'll see. You will see a higher unemployment because we start to see, just from a seasonal standpoint, we'll start to see jobs slow down, and we'll also see a new workforce coming in as grads come into the workforce. So we will start to see higher unemployment, and I think that could give breath at least to hold rates where they are, for the third quarter. And then it's not until the fourth quarter that we would start to see rate cuts. When
you sit around the table with Max Layton and Andrew Honhorst, do they throw things at each other? do they fight it out right now? How does this work?
We've had a lot of arguments about those calls.
Let's get to the yield curve right now. Some of the numbers we see on the screen, 10s around 460, 30s north of 5%. Can we live with those kind of numbers? At some point, usually in the bond market, things become self-limiting. The bond market goes so far, starts to bite into growth, and then things reverse. Can we live with this?
For the time being, yes, but I think we're actually going a bit long duration, but only in the 5-year. So we're not bold enough to go into the long end of the curve quite yet, not into 10s quite yet, because we think that narrative on inflation will continue.
So what do you say to people who argue that at these levels, these valuations of yields, that crimps the overall multiple to such a degree that it doesn't justify further gains from here, especially in some of the high-flying stocks? Why do you disagree with that?
Well, our big driver were PEG ratios. So if we look at that, if we look at the price versus growth, everything still looks valued really well.
Going forward, what are you looking for this week? Is it more going to be the Target earnings and the Walmart earnings, or more the Nvidia earnings? Which is more important to you right now?
More important to me will be the Nvidia earnings for our 7,700 call, for sure.
A big report coming later this week. Rob, it's good to see you, sir.
Thank you.
We appreciate it. Rob Rowe of Citi. Nvidia reporting later this week. We hear from Target as well. A read on the consumer, important for the economy. A read on Nvidia, important for the market. Two different ways of looking at things right now.
What's interesting is you note that the economy might not be as important to the market as, say, Nvidia, and it gives you a sense of how detached these two have become. At what point does actually pain in the economy lead to rate cuts that actually will only boost the multiples in the AI stocks?
Equity futures on the S&P this morning, pulling back just a touch. We're down by 0.5%. Some big moves in the bond market Friday, spilling into the Asian session already through Monday morning. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Good morning. President Trump warning that the clock is ticking for Iran. The two sides are still far apart on any deal to end their war and reopen the Strait of Hormuz. In a Truth Social post, Trump saying Iran better get moving or, quote, there won't be anything left of them. New details emerging about President Trump's meeting with Chinese President Xi Jinping. China agreeing to buy at least $17 billion of agricultural goods annually through 2028. The Trump administration also saying the country will set up boards of trade and investment with the U.S. 3 people were killed in Moscow and over a dozen were injured in Ukrainians' largest ever drone attacks. Moscow's main oil refinery was targeted and a number of residential buildings damaged. Ukraine President Zelensky is saying the strikes were, quote, entirely justified. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie later this hour. Up next on the programme, the President's nuclear red line.
I don't think about Americans' financial situation. I don't think about anybody. I think about one thing. We cannot let Iran have a nuclear weapon.
I have a feeling that first line is going to be repeated again and again going into the midterms. Up next, we'll catch up with Terry Haines of Pangaea Policy, live from New York City this morning. Good morning. A very important week ahead for earnings in corporate America. Check out the calendar. Wednesday, the main event, Nvidia coming after the closing bell. Look out for that. In the week also, earnings from Target, earnings from Walmart. How's the consumer doing? But it's also not just about the backdrop. I think it's really important to point out. Lisa's done this a number of times. This is also about execution. And the winner on execution is Walmart over Target every single time for quite a while.
Building on that, how much are they deploying artificial intelligence in a really concrete way to try to increase efficiency? They did announce some job cuts not so long ago. How much do we hear more about that and where they are seeing a value creation given some of these investments, how that paints the road ahead for a lot of different retailers?
Look for that through the week. Right now in the equity market, check it out. What a really interesting session on Friday. Again, spilling over into Monday. Equities down by 0.4% on the S&P. On the Nasdaq down by 0.3% on Friday, the biggest one-day loss since the end of March. We've had a massive run since then, pulling back just a bit compared to the huge rally we've seen over the last month or so. Switch up the board and get to the bond market. New numbers to talk about. 460 on 10s. Yields up a single basis point. Last week, up more than 20. On 2s, comfortably through 4% now. And on 30s, numbers we haven't seen since 2007 on a closing basis. Your 30-year yield, 5.13.
And if you think that maybe just shifting things around at the Treasury can change this, the problem for any central banker and for any government central bank is the fact that this is global. You're seeing over in Japan the highest rates in 30-year bonds going back to 1997. Over in Germany since 2011. In the UK since 2008. And this is really giving a sense of unease globally that's going to be very hard to push back.
Fueled by this isn't helping. 110 on Brent. Front end of the futures curve, elevated again, up by about 1% on WTI 106. This has become prolonged. I saw a note from Jim Reed of Deutsche Bank earlier on this morning. The ceasefire is now longer than the kinetic phase. The issue is now that this is just prolonged. And it's very, very unclear what's going to stop, what's going to really address the deadlock down in the Middle East.
We're living in paralysis, really, between Tehran and Washington. The president yesterday said that the clock is ticking. He met, according to Axios, his national security team, J.D. Vance, the vice president, Steve Witkoff, Marco Rubio. And basically, it sounds like they are weighing if they cannot make any sort of progress forward when it comes to deliberations on a nuclear deal, then potentially this administration would go back to strikes.
Crude this morning up by close to 1%. Under surveillance this morning, the president's nuclear redlined.
The only thing that matters when I'm talking about Iran, they can't have a nuclear weapon. I don't think about Americans' financial situation. I don't think about anybody. I think about one thing. We cannot let Iran have a nuclear weapon. That's all.
So here's the latest this morning. President Trump issuing a warning to Iran, saying the, quote, clock is ticking for Tehran to make a deal. Bloomberg's Tyler Kendall joins us now from Washington for more. Good morning, Tyler.
Hey, John. Good morning. Well, at this point, the ceasefire remains highly fragile as both sides don't appear any closer towards reaching a deal to end the conflict or reopen the Strait of Hormuz. In fact, we saw escalation over the weekend as the UAE confirmed that a drone had hit a power plant, and Saudi Arabia says that it intercepted multiple projectiles over its airspace. And while several energy shipments have made their way through the Strait of Hormuz in recent weeks, new data analyzed by Bloomberg News and out this morning shows that 23 tankers have clustered near Karg Island, marking the single largest bottleneck there around the export hub since the U.S. began its naval blockade. As all of this contributes and compounds higher prices for Americans and eats into those benefits of higher tax refunds, President Trump has brushed aside the idea that rising costs will hurt Republicans at the ballot box this November, pertinent to the conversation this week in particular as several states hold primaries. Instead, President Trump is saying that this will be a short-term disruption, adding in an interview over the weekend, in part, quote, I'm not going to let the election determine what's going to happen with the war in Iran. But escalation at this point remains very much on the table as the White House's patience wears thin. And Axios is now reporting that President Trump is set to convene his national security team tomorrow to discuss potentially resuming military action. John, over the weekend, Iranian state media had reported that there were some red lines in the U.S.'s proposal that it will not accept, including that the U.S. has put forward that there will not be payments for war damages and that less than a quarter of Iran's frozen assets will be unfrozen. So far, the U.S. has not commented on these reports, but the sides appear publicly very far apart.
Tyler, thank you. Tyler Kendall down in Washington, D.C. To build on this, Terry Haines of Pangaea Policy. Terry, welcome back to the programme. Let's set the stage. You're a Republican in a tight race, facing down a midterm election. What are you thinking about the messaging coming from the president?
I think the quote's unfortunate, of course, but the context can be built on if I'm that person. The president's ultimate point here is that kind of tightly bound around the quote in question is that you can't let Iran have a nuclear weapon. Republicans are foursquare behind the president in that, so I think you can make that case and push with voters, number one. Number two, there's only a handful of races, a dozen or more, that are genuinely competitive. So the vast majority of those Republicans may see this as an irritant, but not as some sort of an existential setback for their own political futures.
Terry, though, are they potentially at risk of making the same mistakes the Biden administration made?
Oh, sure, always. I think it's much less likely that they make that sort of they make those sorts of errors, principally because they understand better than the Biden people did that they're going to need to make the economic case, number one, and it's linked to geopolitics, and number two, that people by and large aren't convinced. The Biden people, kind of like to cocoon themselves and talk about how, if as other administrations did too in the past, that if only people understood a little bit better, and sure they will, and all the rest, and kind of relying on faith. These folks aren't going to rely on faith. I think that's a bit of a difference.
Terry, how are they doing geopolitically? The Treasury Secretary's at the G7 finance ministers meeting, and he came out and he said that they call upon G7 and all their allies and the rest of the world to follow sanctions regimes. At the same time, when the president left Beijing, he said he was going to consider lifting sanctions on Chinese firms that are buying Iranian crude. Which is it?
I'm a big believer in Emerson's consistency is the hobgoblin of little minds when it comes to politics. And in this case, I think it might be a little bit of both. Of course, what the president's doing is carrot and stick, whereas what Besson is doing is a little bit more stick to try to get the allies to stick together.
How important is it that the U.S. clarifies its stance on Taiwan after the president said that he might think about delaying some of the sales that the U.S. has promised to the region?
I think Taiwan's right to be nervous, but I think Taiwan's right to be nervous at least since Biden pulled the United States out of Afghanistan, frankly, because that led to perceptions of a power vacuum in the Asia-Pacific region that are still with us today. So I'm not blaming Biden, I'm not whataboutism here. I'm just saying this goes back years. This isn't a situation the president is creating. So I think Taiwan's entirely right to be nervous. At the same time, I think the president's a little bit less, a little bit more ambiguous, frankly, rather than less, because you got a situation here where there's no change to the bottom line. And number one, number two, what the president's doing is saying what people already knew to be true, that he's considering particular arms sales. So we'll see where this goes. But I point out that there's a linkage here between what goes on in the Strait of Hormuz, China's ability to tell its client state, Iran, look, you better cool it and open the strait, and exactly how things proceed, whether it be on Taiwan or trade and tech for that matter.
Do you have a sense who within the cabinet of President Trump is the guiding light right now in all of this? Or is it really President Trump? I mean, does anyone have an edge in what the overall goal is or the overall strategy?
I look to Bessent economically. I look to Rubio as far as the diplomacy goes. But this is very much the president. With those particular whisperers on board and kind of helping to guide.
Terry, what did we get out of the China summit? I spoke to Ambassador Greer there. He said he gives China a passing grade when it comes to rare earths, but still admitted to what I said we hear from companies, which is that China continues to drag its feet. What did the United States actually walk away with?
I think what they want, I think we don't know yet, and that's why I say that markets need to watch the strait, really, because for trade and tech as much as for oil. China has made much in the past 3 to 4 weeks about saying that they think the strait should be open. Iran is China's client state. You can't put too fine a point on that. And as a result, what you end up with is a situation where either China can tell Iran that it needs to come to some sort of an understanding or not, and that's going to be a directional signal for the entire China-United States competitive relationship, whether it be geopolitically or frankly in terms of whether the summit result is some sort of a continuation of a colder truce that's existed for more than a year, or whether we're going to get to something that's a little more directionally positive.
Terry, are you suggesting there might be an agreement here that's just not been talked about publicly yet?
Oh, sure, yeah. I'm suggesting saying that absolutely out loud. You get a lot of people on your air, other air, from past administrations, John, I'll speak English for a minute, kind of boffins who, work in trade or somewhere, saying, well, it's not like the old days where there used to be agreements and whatever else before the leaders met. Well, that's true, but what's happening here, I think, is a world where the lack of agreements, the lack of progress over periods of years, over trade deals, for example, led to the kind of difficulties geopolitically and geoeconomically that we see today. Leaders of all stripes want to speed that up. And because they speed that up, it's kind of a situation where, their behavior at the summits and agreements at the summits dictate future performance in the markets rather than the other way around.
I'm bilingual, English, American English. Terry, thank you. Appreciate it. Terry Haines of Geopolicy. Terry, thank you. Any evidence of that agreement taking place?
Not yet. I mean, I think we have to wait to be seen what happens the next few weeks. Terry is right. We'll get more of a readout now, potentially the next few weeks, and potentially what happened behind closed doors. One thing that is interesting, Mohammad Ghalibaf, who's one of the negotiators on the Iranian side, was over the weekend appointed to envoy for China. So potentially, and he's one that, he watches Bloomberg Surveillance sometimes because he literally steals quotes from people like Jeff Curry after watching our interviews. So he's someone who's interested in the oil market.
Watch this space. We'll stay on top of that story. Up next on the programme, we'll catch up with Sarah Kunst of Cleo Capital as investors await Nvidia earnings. And we'll check out Nvidia in the pre-market. Firmer this morning, down on Friday, following a 7-day run where that stock rallied 20%, which in Nvidia terms is about $1 trillion. More on that in just a moment. From New York City, good morning. Stocks down again this morning. We're negative by 0.4% on the S&P, down about a third on the Nasdaq on Friday. The biggest one-day loss going back to the end of March, but still just about squeezing out a 7th consecutive weekly gain on the S&P, the longest since December 2023. One name to look at in the pre-market, let's check it out together, Nvidia. Nvidia in the pre-market this morning up by about 0.7%, down on Friday by some 4%. That's about $250 billion in market cap, which sounds like a lot of money. It is. 1 trillion is a whole lot more. We had a 20% move on Nvidia over 7 days heading into Friday. So the move up, way, way bigger than the small move down.
So I love that we used to think that $5 trillion for a market cap for a company was big, because we're actually looking at $6 trillion for Nvidia based on this $900 billion 20-day rally in the name. People are now waking up to the fact that they're going to be huge beneficiaries of any kind of capex cycle. And the earnings that we've gotten so far have exceeded expectations pretty consistently across the hyperscaler board, with the exceptions of a few laggards. How long can this continue? What do they have to deliver? Does it have to be just another leather jacket and some wonderful vibes? Does it have to be some sort of new development? Does it have to be the H200 chip? What can Jensen Huang say to materially change this other than believe the faith, it is changing the world and the orders are strong?
It seems to be in the hands of others, right? Anthropic, OpenAI. It's the announcements that the Anthropics of this world make that have really driven the whole ecosystem in the last 2 months.
Yeah, the race, the existential race to try to remain superior when it comes to some of these skills. How much can Nvidia really say when it really does lie in the hands of others? And frankly, it's sort of a sentiment driver too. I mean, this is how do you evaluate whether it's worth $6 trillion or $6.1 trillion? Exactly. Vibes. I mean, how else are people evaluating this?
Vibes of real earnings. The stock is up by 0.7% at the pre-market. The earnings drop on Wednesday. Look out for that. I want to check out the bond market, check out the moves this morning, and think about some of the levels we're at. Twos north of 4%. Big gap opening up now between where the policy rate is and where the market is, at least on a 2-year relative to the policy rate at the Federal Reserve. And a lot more people starting to come around to the idea that, yes, maybe we might have to hike interest rates, but even if we don't, they might have to signal something close. On 10s, this is where things get more interesting. 460. New highs for the year, yields up another basis points. On 30s, up another basis point or two, 513. We haven't seen these kind of levels going all the way back to 2007 at the very long end of the yield curve. And check it out globally. Lisa went through some of the numbers for the 10-year. These are the numbers for the 30-year. For Germany, the highest since 2011. For the UK, the highest since the 1990s. For Japan, at the long end of the curve on 30s, the highest on record, with some big moves overnight.
Which is a reason why it's hard to see the U.S. market really diverging meaningfully and coming down. This is a reason why so many different central banks are contemplating rate hikes, even in Europe, despite the fact that the growth trajectory is that much lower than in the United States. At what point do you have to see rate hikes in order to tame the bond market? And at what point is the bond market pricing in not just stagflation, but reacceleration? Because you cannot have sustainable yields at these levels unless you have commensurate growth as well. Does AI fuel the growth that allows yields to remain high as the rest of the economy really struggles?
Can we live with it? Can we live with those levels? Can we live with this? Crude at about 110 on Brent. WTI around 106, and advance again this morning, higher by some 1%.
Well, it depends who you ask. The American people certainly, if you look at polling, are not liking the higher gas prices. This from AAA. Travelers are preparing to hit the road in record numbers next week, and drivers will be facing the highest Memorial Day gas prices in 4 years. So they expect record number of people paying very sky-high prices when it comes to gasoline.
Brent crude, front end of the futures curve, 110. Just hanging out there this morning, just kind of stuck there, north of $100 a barrel. That's the price action. Let's get you some top stories. On our radar this morning, President Donald Trump issuing a new warning to Iran, writing in a Truth Social post that Tehran better get moving fast or there won't be anything left. The post coming just hours after drones targeted a nuclear plant in the UAE. Elsewhere, China's economy seeing a slowdown in growth across the board. Industrial production slowing to a nearly 3-year low as investors call into question Beijing's reluctance to add to economic stimulus. And finally, the Manchester mayor and Prime Minister hopeful Andy Burnham making a bid to reassure markets. Burnham telling British media he supports the current limits on borrowing and spending, as well as a plan to lower the nation's debt.
Putting this into perspective, the reason why the bond market got very nervous about Mayor Burnham was because he previously said the government's economic approach left the country, quote, in hock to the bond markets. People said, you don't respect us, we will burn you. And now you have him coming back and saying this. Let me say this really clearly. I support the fiscal rules, saying there's got to be fiscal discipline. talking about rock-solid public finances are crucial to any plan. How he gets there still is a question mark. What kind of commitment he has to this. Again, he tends to be a shapeshifter, as I've learned extensively over the weekend in different kinds of reading. Nonetheless, the bond market feels seen, and so there's a little bit of calm.
Well, they want to also make sure that this individual isn't going to be Liz Truss Part 2, which is what some of them are talking about. I spoke to Guy Johnson earlier this morning. He said the market is definitely worried that he could be left of Keir Starmer, will raise taxes on wealthy and increase unfunded borrowing. At the same time, he says, as the mayor of Manchester, he was fairly business friendly. So to your point, maybe this individual is a little bit of a shapeshifter.
There's two things I'll say about this. One's on the race and two is on the bond market. Let's start with the race. This is not over and done with.
Yeah.
There's still a by-election to take place. And this is a seat that voted overwhelmingly Leave back in 2016. And this is an individual who needs to answer a lot of questions about where he thinks the UK should sit with regards to Europe. There's going to be a lot of pressure on him in the next few weeks. So that's the race. One. Two, the bond market. It doesn't matter for me right now who the Prime Minister is, who the leader of the Labour Party will be, because the hard decisions will never be made until the alternative is worse. And I've said this a few times. What am I talking about? When I say until the alternative is worse, I mean when they have no choice but to make the difficult decisions that will be deeply unpopular with the general public. That alternative will be when this bond market pressure builds and builds to the point that they've got no choice. So you've got two scenarios right now for me in the near term, either slow decay or very fast decay, but ultimately you end up in the same destination. They won't do the hard things, either party, doesn't matter who the leader will be, until the alternative is worse. Now, if you can come up with a better solution to all of this, I'd love to hear it, but at the moment, that's the only one I can think of. The pressure becomes so great in the bond market, they have to do things like cut entitlements, cut spending across the board, mean test things, start to do things that they don't even want to think about because they know they won't get elected.
Right now, the bond market is tending to agree with you. People talk about the Liz Truss moment in 2022. So far, you've seen bond markets at the same levels during that Liz Truss moment. Liz Truss lasted 3 days. Then it was Rishi Sunak, who also got pushed out. Then you've got Keir Starmer, who's getting pushed out. I mean, who is going to actually be able to stay there until there is no other alternative? Right now, the bond market seems to be moving in the same direction. Price down, yields up.
Did you inspire the Bloomberg Morning quote today? Margaret Thatcher, if you can't afford it, you can't have it.
There you go. You know, it's true. It's true. And the line that I've heard from Mayor Burnham on the bond market, we talked about this last week. If you don't want to be driven by what's happening in fixed income, don't borrow the money to begin with. Don't borrow the money to begin with.
You can hate the bond market, but when you owe money, it ultimately will rule you. Period. Full stop.
Let's talk about tech. Much better story. Nvidia shares recovering after snapping a 7-day rally on Friday. The next test for the chip maker due Wednesday with first quarter results. Sarah Kunst of Cleo Capital writing, this earnings is unlikely to have last-minute surprises. Consensus is there's still a bit more upward space for the stock. Sarah joins us now for more. Sarah, welcome to the programme. What kind of things will you be looking for on Wednesday?
I'm most interested in what's going to happen on a go-forward basis. I think we know Jensen. We know that he's very skilled right now. He's likely to get that $6 trillion valuation because the market wants it probably almost more than he does. So I'm curious, though, about their forward revenue forecast because we are seeing a weakening in the overall AI story, and they are a huge chapter of that story.
Sarah, bigger picture, there's a line that stuck out to me in your notes. If we have to start paying what AI costs, we may use less of it. Can you just build on that just a little bit more? How important is that line to your outlook?
So you know, we saw with OpenAI, they closed Sora. What a lot of us didn't realize when we were trying repeatedly to make bad videos last year on it, is that it was costing up to $5 per 15-second video. And if somebody said to you, hey, every time you hit refresh on that video, give me another $5, even if you can afford it, you're probably not going to spend that. And so as the real cost of these things get passed on to consumers, as we see sort of a push up in the cost of tokens, the cost of subscriptions, I think you're going to find that for a lot of people and even enterprise, they're going to use a bit less of it.
Are we seeing any evidence of that, Sarah, given the fact that a lot of big companies are still pouring billions of dollars into even experimental uses of some of this technology of fear of being left behind?
Well, I think it's fear of being left behind, but more practically, it's fear of the stock price being left behind. We're seeing right now this fascinating correlation. People like Microsoft have a leaderboard saying, hey, how much money can you burn, right? And if you give me a big enough campfire, I can burn a lot of money quickly. And so I think as those things decouple, as enterprise leaders start to say, maybe we shouldn't just incentivize our engineers to burn cash, pretty literally, that you will start to see some of that pullback. But I think that that's not going to happen until the market consistently stops rewarding these big companies for spending the way that they are spending. There's no real evidence that we're getting kind of better outcomes, better tech, that even that it's really driving the layoffs. We just know that right now, if you can brag about how many tokens you're using, the market has been rewarding you.
How important is it also that Nvidia ultimately doesn't have a monopoly, but is certainly has an oligopoly over the market, and it seems like the best consumer, the best provider of some of the chips that are being consumed? Do the competitors have any kind of inroads to make based on pricing?
Absolutely. And it's not just pricing, it's also, innovation and availability. Availability, I think, is going to be slightly less of a concern as we sort of potentially will see demand weaken. But the reality is that there are a lot of really good chip companies out there in terms of designing chips. The real sort of bottleneck, the real control is at the more Taiwan Semiconductor level, because they're kind of the only people in the world who can reliably make the chips. And Nvidia has had an incredible run. They're going to continue to be a great company. Do I think that they are nearly as far out ahead in the lead as they were even a year ago? The answer is obviously no. Google is very deep in this space, as are a lot of other big and smaller companies.
Sarah, you're right that it's going to be a temperature check on how the market feels post-China trip. It doesn't seem like Nvidia got anything from this China trip. Is the market potentially going to sell off on that?
I think that that's kind of the point. I will long say that Jensen is the most skilled politician of our age. He's probably the only man who can consistently keep Xi Jinping and Donald Trump on side. And I think we saw some of that politicking with his last minute fly-in for the trip. I'm pretty sure that he is comfortable with the outcome of it, even if the outcome kind of felt like nothing, because when you're between a rock and a hard place, being able to just sit there might be the best outcome you can hope for.
Sarah, appreciate your take. Going into a big earnings report, Sarah Kunst of Cleo Capital on Nvidia. The president and maybe this administration holding one position. It's unclear what China's position is on those chips.
So the H200s, as of now, China has not let firms buy, even though the U.S. since January, this isn't new, since January said China was allowed to buy them. We're still waiting for the central government, the CCP, and Xi Jinping in the end to say, yeah, you can buy these chips.
Stock is up in the pre-market by 0.4% heading into earnings on Wednesday. Let's give an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. The World Health Organization declaring an Ebola outbreak in the Democratic Republic of the Congo and in Uganda. An emergency of international concern due to cross-border spread. The outbreak is caused by a rare virus strain which has no approved vaccine or treatment. Treasury Secretary Scott Bessent is calling on G7 nations and others to increase sanctions on Iran. Bessent is in Paris for a meeting of finance ministers and central bank governors. He is wrapping up an international trip that included stops in Japan, South Korea and China. The nation's largest commuter railroad coming to a halt. Long Island Railroad workers striking for the first time in 30 years. The MTA is advising people to work from home if possible, with free shuttle buses and helicopter rides available as alternatives. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Some first world problems. Helicopter rides available as alternatives.
Yeah,
what is Blade offering?
Blade is offering 95 commuter flights. $95.
Okay. It's not bad, is it?
Honestly, it might end up... Look, this is a fantastic marketing scheme. When I saw that they were doing $95, because people are going to get on that thing, it's going to take them 5 minutes, and they're going to say, I'm going to do this, and they're going to jack the prices up to $500.
I would never get on a helicopter.
Really?
For the record. Ever.
Why?
I'm never going to get on a helicopter.
Not on a helicopter, not on a cruise?
No.
I would get on a helicopter.
Different reasons.
I was half asleep, and I was actually trying to look at it. I didn't see $95 on that.
Up next on the programme, bond yields unhinged.
Bond yields definitely feel like they're getting a bit unhinged. The bond market's actually starting to say, pay attention to all the dynamics that are happening.
Up next, we'll catch up with Berro of JP Morgan Asset Management, live from New York City. You're watching Bloomberg TV. Starting your trading week just a little bit softer, negative, down by 0.4% on the S&P, down by a third on the Nasdaq 100. Yields are elevated across the curve, 2s, 10s, 30s, 2s through 4%, 10s now at 460, up by a single basis point. And over in Japan, at one point, the long end of the curve up by some 20 basis points overnight. That was a messy session over in Japanese debt markets. Under surveillance this morning, bond yields unhinged.
Bond yields definitely feel like they're getting a bit unhinged. The bond market's actually starting to say, pay attention to all the dynamics that are happening. Higher oil prices, the potential impact of debt and deficits, not just in the U.S., but globally, and then the overall picture of this war is not getting resolved anytime soon.
So here's the latest this morning. Bond yields testing fresh multi-year highs. The stalemate between the US and Iran fueling inflation fears. Berro of JP Morgan Asset Management writing, we wonder if parts of the rates market are conflating a commodity-driven inflation shock with a broader inflationary backdrop, something that has not yet been borne out in the data. Kelsey joins us now for more. Kelsey, good morning.
Good morning.
It's good to see you. We've experienced this a number of times. We've talked about it. We had a sell-off back in March. We had sell-offs under Secretary Yellen when she was running the Treasury. Bond market really tested her. How different is this one compared to those?
It does feel somewhat different, particularly compared to last year at this time when we had the sell-off related to Liberation Day, or even the sell-off in 2022 related to broad-based inflation, demand-led inflation. And I would say the big difference that I'm noticing are the flows. So if you look back at last year at this time, when fixed income returns turned negative, you started to see retail flows also turn negative. This year, we're not seeing that. If anything, the demand for fixed income is accelerating at higher yield levels, particularly in credit and also outside of credit, for example, in emerging markets.
Well, let's isolate one part of fixed income when we talk about treasuries. Is that demand broadly even across the curve or specific segments of it?
I think it depends on where you are and what you're looking to hedge and also where you're coming from. A few years ago, it was all about talking about moving out of cash. And I still think looking at valuations relative to cash is an important way to anchor yourself in terms of the valuations of the fixed income market. So I look at the 10-year now, and we're approaching 100 basis points of spread on the 10-year Treasury relative to the Fed funds rate. And that is a pretty important level historically in terms of when you're looking at forward returns for fixed income, the return profile does look a bit more favorable when you're at these wide of spreads and these steep of curves.
All of these price actions and the money moving from cash into bonds makes sense if you have a reaccelerating economy. If you have an economy that actually is not in a stagflationary environment at all, but is actually really seeing positive growth and able to absorb the higher inflation. How do you push back against that scenario, which seems to be priced in across bonds and across stocks?
So I would agree. There is a risk premium being priced, and that's the reason that you're seeing the market price in hikes. Because if I think about a true hiking cycle, if the Fed's going to restart a hiking cycle, they're not just going to hike once or twice. They're going to hike multiple times. And it's going to be on the backdrop of a stronger economy, one where the inflation is not just narrowly based in commodities, but spreads to a broader part of the economy. And I think to make that conclusion at this point, there really isn't enough in the data to make that conclusion. So when I looked at the CPI and the PPI numbers, yes, face value, they're not good. They're not good for central banks. They're also not good for consumers in terms of what that means for real incomes. But then when I break it down in terms of the components within the PPI, the big upside surprise came from transportation, which is a function of commodities. And when I look at CPI, again, it's really coming from airfares and gasoline. If anything, we're actually seeing that the tariff inflation from last year is rolling out of the inflation data the way that central bankers would have expected them to. So how do we see when that cyclical turn is coming? If it's coming, I would need to see a reacceleration in wage growth. And that's not necessarily something we're seeing now.
Can you see a reacceleration in the economy without the economy participating? And I mean this by the idea of AI and the overlay and all of the spending that has contributed to inflation in a number of different components and potentially for consumers as well. Without the consumers feeling good, without them seeing huge wage increases, without them really increasing their spending materially.
Yeah, so we've been talking a lot about this idea of multiple R-stars. All of this debate around interest rates right now, I think the question people are coming to us and asking is this sustainable? Can the economy really withstand 30-year yields above 5%? And, the answer really depends, because if you look at certain parts of the U.S. economy, like the housing market, or look at investment outside of AI, the answer is no. I don't think that these interest rate levels are helpful. If anything, they are fairly restrictive for parts of the economy. But other parts of the economy, particularly the CapEx build around AI, is really not very sensitive to interest rate policy, and that seems to be a fairly immune. And we're seeing it in terms of the issuance patterns within investment grade and high yield, all of the data center issuance that is coming out. It's changing the components of the index, the makeup of the index, and is generally being met with strong demand, even at higher yield levels.
What do you think the Fed's North Star is?
I would say it's a little difficult to say, and this is the reason why I think there's another reason why yields are elevated, which is we're going through a transition where we need to understand how the new leader of the Fed is going to approach this backdrop. Now, if I were to assume continuity, I would assume that this is still more like last year, in the sense that we faced a shock and it caused the central bank to stay on hold. Not necessarily to start a hiking cycle as a result of commodity-led inflation, but to maintain policy at its current level. But, this is going to be a new regime, and we're going to need to understand, how he approaches these complicated dynamics.
Can I jump in? If he chooses to anchor front-end rates, does it leave the long end vulnerable? What's the relationship between the front end and the longer end of the curve?
Well, I actually think that if he were to be more aggressive in terms of hiking into a commodity-led inflation shock, that would actually result in a curve flattening. So yields in the long end would be capped, if anything, here. So we'll see.
Can I reverse engineer that?
Yeah.
So if he does choose to anchor front-end rates, does it leave the long end vulnerable?
Oh, so if he keeps...
Precisely.
Okay. It depends. I would say what you need to watch there would be inflation expectations. So far, the inflation expectations market is not saying that this is going to be a broad-based inflationary regime. But if you start to see five-year inflation swaps start to move up, 30-year inflation break-even start to move up, that's an indication of a dovish policy error, which is essentially what you're describing.
I wonder how close we are to that. Kelsey, it's good to see you. Lots to think about. Kelsey Berro there of JP Morgan Asset Management. Up next on the programme, we'll catch up with Dan Greenhaus of Selloffs Alternative Asset Management, Sucharita Kodali of Forrester, and Francisco Blanch of Bank of America. From New York City, the second hour of Bloomberg Surveillance. Up next.
The economic surprises are trending up, not down.
The incoming data in the U.S. has been more resilient.
There's a lot of uncertainty about where this goes.
There's more pain yet to come.
We don't think we're at a tipping point, but I do believe that the risks now are heightened.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equities pulling back once again. We're down by 0.4% on the S&P, softer by about 0.38 on the Nasdaq 100. In the bond market, yields elevated once again, 460 on 10s. Numbers we've rarely seen at the long end of the yield curve in multiple decades. On a 30-year, 513 this morning, with crude up on Brent and WTI. Brent crude 110 a little bit earlier in the session. We hold those levels. WTI around 107. Going into this week ahead, stacked with earnings. A read on tech from Nvidia, a read on the consumer from Target and Walmart.
Which is going to be more important? Well, maybe for the economy and the sentiment survey coming out of the University of Michigan, it's going to be Walmart and Target, potentially, as well as Home Depot and Lowe's, particularly when it pertains to the housing market. When it comes to the market overall, it is Nvidia, first, foremost, and last. And this is ultimately the story of the moment, which is how independent is the market from the underlying economy in the era of artificial intelligence? Do we have, as you've talked about, a two-speed economy that doesn't listen to interest rates and doesn't listen to consumer spending?
To that point, how resilient is it in the face of these moves in interest rates? 2s, 10s and 30s elevated across the curve, not just stateside, but worldwide. And a real test starting to build now for the incoming Fed chair, Kevin Warsh.
Absolutely. And I think it was actually interesting that as Kevin Warsh was going through key hurdles in the Senate, the president sat down with Fortune magazine. This is before he went to China, and they released that interview this morning. And this is what the president had to say, basically conceding that it's okay. We might have to wait for the data to come in, and understanding that higher energy costs might actually mean higher inflation. And you said it earlier. That quote the president said about, I don't think about the financial situations of Americans. He was talking about when he was dealing with Iran and nuclear Iran. But at the same time, when you're going to Memorial Day weekend, $4.51 on a gallon of gasoline, that's going to hurt.
You know what they'll do in Washington and across the country. They'll edit out the context and replay the epicenter of that particular comment over and over again going into the midterms. As for the Federal Reserve, things have become much more finely balanced. Just check out the conversation we had with Kelsey Berro of JP Morgan Asset Management about 10 minutes ago. Really enlightening. Are we on the edge of a dovish policy mistake or a hawkish policy mistake as some of these central banks? And the answer to that, much more finely balanced than it was a month ago.
Maybe the answer is yes. I mean, they are damned if they do and they are damned if they don't. Ultimately, it depends also on the economy. And this is really key, especially when it comes to a place like Europe, where continental Europe is facing a much bigger oil price shock. At the same time, a much lower growth rate going forward. How much are their hands tied when it comes to rate hikes? At the same time, they are signaling rate hikes more than the U.S. Federal Reserve is. So try to square that picture. In the United States, you asked this question, and I think that it is a really important one. A lot of people have been talking about it. How much is the move in the long end, because the Fed has not taken away the easing bias that it has? How much is this a market that believes that this is a compromised Fed chair coming in who will be overly dovish and is skewed to the dovish mistake? How much work does he have to push against that?
A lot of work. 1, 2, I don't know. To the other question, and I think this is part of the reason you've seen this move in the bond market, just a lack of clarity around the incoming reaction function of the incoming Federal Reserve Chair, Kevin Warsh, and we need that clarity, and you might not get it until the news conference a month away.
Yeah, again, incredibly important. We are going to be hearing from a whole bunch of other Fed officials this week. Do we start to see the importance being reflected in their speeches about removing the easing bias, and will that be enough to curtail the move in the long end?
He's got a free pass, hasn't he? You mentioned the comments from the president. He's got a free pass. Treasury Secretary's backed away on this issue. The president's backed away on this issue, just giving the incoming Fed chair a bit more space to say, sure, drop the easing bias, let's get back to neutral and figure it out through the summer.
They're giving him a lot of room in the beginning, in the first few months, to really just basically get used to being the Fed chair and not having to rush to cut rates. The president knows you might not be able to do it while this war is still ongoing.
513 on 30s this morning. Coming up this hour, we'll catch up with Dan Greenhaus of Selloffs as the bond market looks for stability. Sucharita Kodali of Forrester previewing this week's retail earnings, and Francisco Blanch of Bank of America as fresh threats to Iran has crude rising. We begin this hour with stocks facing pressure following a sell-off in the bond market. Dan Greenhaus of Selloffs Alternative Asset Management writing, I'm not as worried as some others. Since 2024, the 10-year has averaged 4.25. We're not that much higher than average. Dan joins us now for more. Dan, good morning. Good to see you.
I wrote that a couple of days ago.
Oh, things have changed.
We've moved a bit since then, so
okay.
Yes.
Has your view changed?
No, listen, no, it hasn't changed very much. We're at 460 on the 10-year. We've been here a couple of times over the last few years. If I wanted to be cute, you could argue that around 460, 470, you've had some periods of momentary equity weakness. And today with the S&P basically at a high, borderline overbought, you could certainly have a 5 or even 6, 7% correction right about now. I think the question becomes, is this a secular shift for investors right now? And I don't think anything new is being priced into the bond market per se. Inflation obviously is turning up a little bit at levels above what the Fed would prefer. This is, I think a lot of people have been arguing for this for a while. The bond market seems to be catching on to it now. But you also have, as I'm talking, I found another point I want to mention. You also have idiosyncratic differences across the globe. You have the political instability in the UK, you have the infrastructure bill in Germany, you've got a supplementary bill now coming out of Japan. The US is dealing with some version of all of that. So there are idiosyncrasies across the world. But no, at the 10-year at 460, am I secularly worried for investments? I don't think so.
Well, let's just park equities just for a moment and stay on fixed income and look at these numbers, not just in the UK, but in the US as well. I want us to talk about the US specifically. Typically in bond market sell-offs, they become somewhat self-limiting. You get to a level where people just start to freak out about growth and then things start to reverse. This time I wonder whether you need corrective action from authorities. And by authorities, I mean the Treasury. And I'm thinking back to the sell-off under Yellen. Yellen had to come out and ultimately tighten up duration, bring in a lot of issuance to the front end of the curve. And that kind of corrective action just put a lid on yields and moved the bond market in the opposite direction. Does this fall on the desk of Secretary Bessent, or is it someone else's job to do something about this?
I don't think it falls on Secretary Bessent's desk. You could probably throw 2018 in there also, when the bond market needed the chair to come out and say, maybe we aren't so far from neutral or something like that. Listen, the inflation story is very real. I think something that we've discussed on air and other people have as well is the oil story, which is a big part of this, specifically the sanguinity, which isn't a word, but we'll use it. We can run with that. I know what you mean. Of many market participants about what was going on in the Middle East. And the argument I and others have been making is this can only go on so long because the buffers that were in place prior to the war's start are going to run out. We had record oil on water, record inventories. The market was already 1.5, 2 million barrels oversupplied. You see this morning, I think it was the IEA came out and said inventories are being drawn down at a record pace. That we know this. Oil inventories in the U.S. are below 2025 levels, below 5-year average levels for distillates, for gasoline, for crude oil, for just about everything. So you are at the moment where you are really running out of time. And so if you don't get the Strait open, if you can't get the 10, 13 million barrels that are missing back on the market, and even that's going to take some time, there's just a structural upward pressure on oil prices, which has a very high correlation, obviously, with headline inflation. And so I think the story is coming that we've been telling for several months, or several weeks, I should say, is really starting to come to the fore now.
When does this toxic brew paint a negative picture for risk assets, given the fact that they've been divorced from everything?
So, you know, I'm not sure that I would go so far as to say risk assets have been divorced. And what do I mean by that? Well, obviously, the broad indices are at a high, but tech is doing a lot of work right now. And I think one of my favorite stats that I'm not sure people realize, although I'm also not sure that it has much value, is that there are more stocks in the S&P 500 down 20% right now than are up more than the index. So the index, let's unpack that for a second. The S&P is up, call it 8.25% year to date. It's about 170 companies in the S&P that are up more than 8.2% or so. At any given moment, you probably want that to be half and half. Half are beating the index, half are trailing the index. Right now, it's only about 170 stocks. 190 stocks in the index or so are down 20% from the high. So there is underneath the surface weakness that is related to Iran and the higher interest rates and uncertainty in tariffs, et cetera, et cetera.
Yeah, there's bad breath, and people have been talking about this, that it's been a really narrow leadership. Can that narrow leadership continue to outperform if this Federal Reserve signals that it's going to hike rates?
I think so. Well, for a long time, I would have said I think so because the AI story has been so interest rate insensitive. But obviously, as we all know and we've discussed, we're shifting into a period where you've got hundreds of billions of dollars of debt issuance coming to market for a lot of the hyperscalers, Oracle being the poster child for this. I think Issuance this year is probably going to be somewhere around 225 billion, 240 billion, something like that. So obviously interest rates become more of a story for this. But this is a secular investment theme, whether we like it or not. And by we, I mean bearish people, even though I'm not in that camp. But like, it's happened. It's not.
You're like we, pointing at me. Carry on.
No, it's not me.
Good morning, Lisa.
There are people who are. Listen, now we can shift into the bubble conversation, but this is happening. Every single company, every conference call, every conference appearance, demand exceeds supply. That's from the hyperscalers to the semiconductor to the comm equipment. You've got names like Lumentum and Ciena joining the party. Ford is an AI stock now. So there's a lot going on here that thus far is completely borne out in the investment and the demand data. And when I say whether we like it or not, I mean there are people who keep pretending like this isn't as big as it appears to be. It is. It's obviously an important secular investment theme. And so again, if interest rates go higher, if the Fed starts hiking rates, I mean that's obviously going to change the calculus a little bit. Do I think Meta is going to invest less if the Fed raises rates 25 basis points, which I don't think is going to happen? No, I don't think that changes their capex at all.
I mean, you also say that valuations for many large companies remain short of the bubble territory for a lot of these companies. So who do you think is in that bubble territory?
Well, I don't know. Look,
you said let's shift the conversation.
Let's. So I don't want to. It's hard to know who's in a bubble because you look at something like Micron, for instance, and I've said 100 times, I will say again, Solus, not a particularly big tech investor, but Micron has gone vertical. The PE ratio is 10, let's say. It might even be lower than that. Nvidia, every time they report and the stock goes straight up, we comment about how valuation is coming in. In 2000, the NASDAQ was trading at 125 times trailing earnings, something like that. We're nowhere even close as a broad market to that. At the same time, we have to be honest with ourselves. Just because you're not at 2000 bubble territory doesn't mean you're not in a bubble or you can't go lower. And so I think some people take too much comfort in, well, it's not the dot-com bubble. That doesn't do me as an investor much good. The question is, when I buy a stock, a credit, whatever it might be, when I invest in a company, am I likely to realize the expected earnings stream that I'm forecasting? And I think one of the issues that investors have right now as the market has surged to the highs that it is not only is the first quarter earnings growth number exceptional, obviously, even when you X out the investment income at the hyperscalers, but the next couple of quarters are expected to be exceptional as well. And I don't want to say you're priced for perfection in the stock market. I'm not even sure I've ever uttered those words, but you're assuming a lot of good stuff in the stock market right now that has to come to pass. With the caveat that this investment theme is continuing unabated by all accounts.
I didn't hear bubble in this conversation. I heard inflation repeatedly. When you talk about the economy being supply constrained and all this demand coming into the market that's price insensitive, backed by some of the richest companies on the planet, I just hear inflation, don't you?
Yeah, well, and that's why some of the numbers are what some. I mean, you look at some of the import numbers on the computer and accessories, even in the CPI and the PCE type numbers. Some of that stuff is interest rate insensitive, if you will, and that's obviously putting upward pressure. There's obviously the normal stuff, airline fares, et cetera, et cetera. The inflation story is particularly interesting in the sense that obviously inflation is above the Federal Reserve's target and has been for many years, 5 years.
5 years.
We know this. Complete failure in that sense. At the same time, I'm glad Kevin Warsh brought up the alternative inflation measures, because this is something that I have followed or used in my analysis more closely than I think a lot of other people have. The idea that we would simply restrict ourselves, I'm building up to a point, that we would simply restrict ourselves to two items, food and energy, when in any given month, any item could be quite volatile. Why is that a better measure than Xing out the top 15% movers in any month, or just using a trimmed mean or median, whatever alternative measure you want to use? I think those are inherently, intuitively better. I know some of the data that we've done and other people have done prove that it may not be econometrically better. It may be econometrically equal. But I think just conceptually, and why I mention that is some of those measures are lower. And so I think when you look at inflation through that prism, I'm a little less worried than some other people, because I don't see inflation as being quite the sort of Damocles hanging over the consumer as maybe.
So I would say in response, the concept is great. I'd agree with you. The optics are poor and the timing's really weak, because this will be dressed up in a push to do the president's bidding to keep interest rates lower than they otherwise would be. And I think that contributes on the margin. I'm not saying it's certainly the bulk of the move, but contributes on the margin to the uncertainty around this particular Federal Reserve and what it means for this bond market right now, and the uncertainty around front-end rates and what it means for the long end. Because if you do get a Fed chair that comes in too early talking about these issues for good reasons, I believe they are for good reasons, you start to get a market that worries about the optics. And the optics are the Fed chair will be unwilling to anchor inflation expectations. Therefore, I, in the bond market right now, don't want to put in a bid. I want to sort of disengage and let 10s run, let 30s run, which to some extent is what has been happening in the last week or so.
Yeah, this is a reason why it's also going to be important to hear what the other Fed officials are going to say and how much they back those measures. I think Chris Waller is actually going to be a really important voice going forward to validate, in some ways, some of these moves. And he's talked about that, the need to change certain things, including the inflation metric.
460 on 10s this morning. Dan's going to stick with us. Dan Greenhaus there of Selloffs Alternative Asset Management. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John. Thank you. Former UK Health Secretary Wes Streeting making a pitch for a potential leadership bid. As part of his proposal, Streeting calling for Britain to rejoin the European Union, saying leaving the EU was a catastrophic mistake. Swatch closing stores and cancelling launches of its Audemars Piguet pocket watch collaboration after massive crowds raised safety concerns. The company shut nearly 20 stores throughout the United States on Saturday and cancelled events in other countries. Shares of Ryanair bouncing back from early losses in Dublin trading. The budget carrier warning of rising costs this year if unhedged jet fuel prices remain at current levels. Ryanair CEO Michael O'Leary joins Surveillance at 8:15 Eastern. That is your Bloomberg Brief. John.
Vonnie, thank you. Looking forward to that conversation in the next hour. Up next on the programme, the nuclear ultimatum.
The only thing that matters when I'm talking about Iran, they can't have a nuclear weapon. It's very simple. Iran cannot have a nuclear weapon.
We're never going to let that opponent have a nuclear weapon.
Up next on the programme, we'll catch up with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. Stacked week of earnings. Check it out. Tomorrow, Home Depot. Through the week, more on the retail side of things. You'll hear from Target and Walmart. The headline act, though, of course, Nvidia after the closing bell coming up on Wednesday. Equity futures into all of that look like this. Pulling back just a touch on the S&P. We're negative by 0.4% on the Nasdaq. Down by 0.4% also. Under surveillance this morning, the nuclear ultimatum.
Can't let Iran have a nuclear weapon.
It's very simple. Iran cannot have a nuclear weapon.
We're never going to let that opponent have a nuclear weapon.
The only thing that matters when I'm talking about Iran, they can't have a nuclear weapon. I don't think about Americans' financial situation. I don't think about anybody. I think about one thing. We cannot let Iran have a nuclear weapon.
So here's the latest this morning. President Donald Trump issuing a new warning to Iran, writing that Tehran, quote, better get moving fast or there won't be anything left. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John. Good morning. Well, it's clear that the White House's patience is wearing thin here as the ceasefire remains highly fragile. And we saw those renewed regional risks over the weekend as the UAE confirmed that a drone hit a power plant in the country. And Saudi Arabia says that it intercepted multiple projectiles that entered its airspace. Iranian state media the other day outlined that the latest U.S. proposal is considered a non-starter, in part because it includes no payments for war damages and would seek to unfreeze less than a quarter of Iran's frozen assets. Now, the U.S. hasn't commented or confirmed that reporting, but it is very clear that the gridlock is leading to the potential that escalation will be put back on the table, as Axios is now reporting that President Trump will convene his national security team tomorrow to discuss potential military options. It's very clear that recently foreign policy has been front and center with the war in Iran and the president's travel to China, but domestic politics are coming back into focus this week as a flurry of states hold their primaries. And while we can't say so far, actually, that many Trump-backed Republicans are winning their Republican contests, at this point, we do know that the war in Iran is compounding higher prices for voters, which is the #1 issue as we head into November. Now, President Trump says that this will be a short-term disruption in exchange for curbs on Iran's nuclear program, as you heard just there. But, John, at this point, it doesn't appear that we are any closer on getting a clearer timeline on when a deal could be reached. In fact, Iran's foreign minister in a briefing earlier this morning said that Iran doesn't want to talk about the issue of uranium enrichment. It doesn't want to, quote, discuss or compromise on that problem.
Tyler Kendall in the nation's capital. Tyler, thank you. Dan Greenhaus still with us. Dan, let's just finish on this particular story. You alluded to this in our previous conversation, that for many investors, there's a sense that perhaps this story just doesn't matter. Are you on the side of it doesn't matter yet, and we're closer to the yet?
The oil story?
Yeah.
Yeah, I think the problem for a lot of investors is probably that the doomsayers came out immediately saying this was the end of the world. No different than Liberation Day, no different than Brexit, et cetera, et cetera. And so there is certainly a level of disaster exhaustion. When I talk to investors around town, there's a level of disaster fatigue. So people could be forgiven for saying, oh, you told us everything was going to. So with that said, though, there is a math problem. And the inventory story is where it comes into fruition. There is only so much oil to compensate the billion barrels that are missing. There's only so much time that can go on where the 13 million barrels, if you will, that are missing from global supply can be compensated for with those buffers. And I think the problem is people like me who've been talking about this, there's no way to really say for sure because the buffers are hard to iron out. But you are getting to that point. I mean, we can measure the inventory data. Observable inventories, again, are incredibly low. Demand is relatively unchanged. Yes, Pakistan can shut the lights off for a little while. Yes, you can work from home in some Asian countries. But at some point, those chickens are going to come home to roost. And I think, listen, it's not like nothing has happened. Oil prices have doubled. Before this happened, TI was $50-something. Now it's $100-something. So you've basically already seen a doubling of oil prices. It just hadn't gotten to the $125, $140 level that so many worried about. But it will get there. That is a mathematical certainty if this continues.
Today we have the Persian Gulf Strait Authority now launching an X account. Structurally, hasn't this changed? There's now going to be a toll you have to pay to go through the Strait of Hormuz.
The Emiratis and the Saudis are not going to be okay with that. And at some point, this is like, I'm not a geopolitical expert.
I agree with you, but some traders might want to pay that toll to move product.
Will pay the toll and should pay the toll are two different conversations. I think a lot of people will pay the toll. It's a tax. I got to get my oil through, et cetera, et cetera. I'll defer to Halima Croft and the people who are really on the ground in a sense that I am not. But everything I hear, they do not want to pay those tolls.
Dan, it's good to see you.
Always
Thank you,
my
sir.
pleasure.
Lots to think about. Dan Greenhaus, there, Selloffs Alternative Asset Management. Crude this morning, 110 on Brent. Bramo, WTI, around 107.
Yeah, and really it's the 80 days and the fact that this is bleeding longer and longer. And at what point is it a step change? Not necessarily just a slight change, but a step change in prices that shoot up to 120 and beyond.
Francisco Blanch coming up from Bank of America. What do we hit first?
Oh, Francisco's coming. He knows.
Who knows? What do we hit first? Storage bottoms in the West?
Tank bottoms, problem.
Or tank tops in Iran? That conversation just around the corner. Citi Kodali of Forrester looking ahead to retail earnings this week. Tons of them. Home Depot, Target, Walmart still to come. We are coming off the back of the biggest one-day loss since March on the S&P 500, and we have some negative follow-through. We're down by 0.5 on the S&P. We're down by 0.5 on the Nasdaq 100. Similar move on the Russell. The epicenter for a lot of this is in the bond market right now. 2s, 10s, and 30s. New levels to think about. 4.1-ish at the front end of the curve. 460 on 10s and 513 on 30s. Yields higher again across the curve.
Yeah, and this is really stemming from the idea that you've got higher oil prices and a response from fiscal authorities, which is to simply bail out consumers rather than necessarily tighten the screws or figure out alternatives. It's sort of the opposite reaction function that you want to actually curtail demand and ease the fundamental problem. Nonetheless, here we are, and you're seeing yields respond.
A turn to energy. It's fueling the move. Brent crude at about 110. It's the front end of the futures curve. 106, 107-ish on WTI this morning. This is where the pain started. This was the initial shock in energy. And we've been tracking it as follows. Through energy, into rates. Do you see it in growth? Can we live with this kind of level of rates right now in bond markets worldwide without its absolutely hammering economic growth?
I keep thinking about what Morgan Stanley economist said, which is this is the pain point right now for markets because it is not high enough to justify growth for years, but it's not low enough to take the idea of a Fed response off the table. In other words, it creates real inflation that can be tolerated, at least for the time being, based on the fact that consumers are still spending, and there is this sort of existential spending race tied to AI that keeps going regardless of where rates are. You put those two things together, this isn't enough to cause the pain necessary to bring the prices down.
Both those dimensions of this story captured by the earnings for the week ahead. Nvidia coming up on Wednesday, the retailers in between, Home Depot, Target, Walmart throughout this week. That's the story right now in fixed income, in energy and equities. Let's get you some top stories. On our radar this morning, the Long Island Railroad workers striking for the first time in more than 30 years. A shutdown of the nation's largest commuter railroad entering its third day. The MTA advising people to work from home if possible. Elsewhere, the Treasury Secretary Scott Bessent urging G7 nations to ramp up sanctions and crack down on funding the, quote, Iranian war machine. This coming as President Trump expresses frustration with the state of peace talks, telling Iran the clock is ticking. And finally, Elon Musk gearing up for a historic SpaceX IPO. Sources telling us here at Bloomberg the company could file as early as this week. SpaceX is seeking to raise as much as $75 billion on a valuation of more than $2 trillion, making it the biggest listing of all time.
Following on the enthusiasm that we saw last week for Cerebras, given that everyone wants to get a piece of this, SpaceX is going to be particularly interesting. Number one, because it's an Elon Musk company and he always tends to generate a lot of interest. Number two, it is the biggest of the big IPOs that are expected. How much more is the appetite going to be? And three, the race to space is getting more and more interesting as people say we're running out of space for data centers and other sort of AI build out. They want to launch energy up into space, whether it's nuclear energy or anything else. Everybody needs a rocket, right? You're seeing this with every single hyperscaler. They all want a rocket because they're expecting that space will have the materials, that will have the space for energy, no pun intended. And frankly, it'll be the future of exploration.
I spoke to the Blue Origin CEO about this a few months ago, and this is exactly where their head was at. And this is why they're in this race for SpaceX, is why they're not doing commercial flights anymore, because it is a space race. And not only are they competing with each other, they're also competing with the likes of China. Very interesting that Elon Musk was on this trip with the president. I also found it interesting that we have our reporting in this scoop, but he also said at a summit he was supposed to attend in person, he was virtually, and he said because we got to get this SpaceX IPO stuff going here pretty soon. So he's basically, you know, hunkering down in Texas, working on bringing this company public.
It's funny what you see right now in the economy and what you see in financial markets. In the economy, you see supply constraints everywhere and a series of supply shocks that started with goods, the trade shock, then spilled over to labour. We saw what's happened with migration, immigration in this country. That spilled over into energy. And then when you look in financial markets, all you see is supply, not supply constraints. You see tons of equity issuance. You see lots of debt issuance, fueling lots of demand to go into a supply-constrained economy, which is why when we had this conversation earlier with Dan Greenhaus, I was just sitting there listening and just thinking, all I'm hearing right now is inflation. Tons of demand supported by financial markets going into a supply-constrained economy.
It's a cyclical problem that's overlaid with a secular goal and secular spending. At what point does the cyclical problem curtail the hopes and the ambitions of that secular goal? Right now, the bar is incredibly high simply because the promise for AI is so great and people do view it as an existential race. And that's why you're seeing prices go up, even though they usually would curtail themselves based on how much they've risen.
Some of that demand, much of it coming out of those big names, not price sensitive at all. Let's turn to retail. Walmart and Target among the companies reporting earnings this week, giving a new read on consumer resilience. Sucharita Kodali of Forrester writing, Walmart remains the clear retail share gainer, while Target is still in turnaround mode. Sucharita joins us now for more. Sucharita, welcome to the programme. No doubt we'll be talking about the backdrop, the environment, the consumer. But I want to start with something Lisa's talked about continuously with regards to Walmart, and that's execution. What have they done so well over the last several years?
Well, they had some pretty massive store renovations over the last several years that have just done particularly well. Anytime you do a store renovation, you tend to see an uptick in overall just sales because consumers like the cleaner environment. Products are easier to find. Usually there is some science that went into improving some degree of the store layout. And that has been a significant part of it. They also have supported their employees pretty well in the last few years with whether it's benefits for AI training or other types of upskilling. So that tends to also reduce some of the churn that you tend to see in retail. And whenever you can reduce churn, you tend to have better employees who can, kind of essentially answer shopper questions and put things where they need to go.
Sucharita, is Walmart still representative of the overall economy?
Well, Walmart is in that it is doing well right now. It is at an all-time high, and that speaks to how the economy is actually also doing as well, which is that even though there is this sense that the other shoe is going to drop at any moment and we are going to enter a recession, the major macro indicators, whether it is GDP growth or whether it's unemployment rates, are actually pretty strong. Retail spend is at an all-time high. And when retail spend is at an all-time high, you can bet that it's usually Walmart and Amazon sales that are also doing well.
The reason why I ask that, Sucharita, is because increasingly the large are getting larger and they're being more successful because they have economies of scale, because they can negotiate better rates, they can withstand these supply shocks that are repeated. And frankly, the likes of both Amazon and Walmart have other businesses. They have data that they can sell to advertisers that more effectively create a product. They have entertainment. They have their online shipping. They have a whole host of other kind of subsidiaries that can bolster their earnings. How much are they stealing share from everybody else? And you're going to see that reflected in the earnings that we get from the other retailers, Target among them.
Well, certainly Target has suffered pretty tremendously in the last few years, but that has been kind of the opposite of Walmart's issue, which is there's been execution, which has been challenged on the negative side. But at the same time, there are other big retailers that are also continuing to grow, like companies such as Costco, as an example. There's a significant amount of growth for the very, very small retailers and merchants as well. We have to remember that some of the merchants that are doing particularly well are some of those e-commerce players, whether they are Shopify merchants or whether they're TikTok sellers. And their growth rates are doing quite well right now. Because a lot of this sense of being able to discover products through social media or other internet channels is prevalent as well. This narrative of the middle being challenged, those mall merchants, the big box merchants, that's not a new narrative. It is something that many of those mid-tier companies have been incredibly challenged by because they, for the most part, sell commodities that are now available typically they're available online. And when you sell commodities and you're not pricing them in a more favorable way, you're not going to gain share. And you also have the added expense of essentially real estate on top of everything.
Sucharita, how difficult is Home Depot going to have it this week, especially given the backdrop, what's going on at rates?
Their issue is primarily an interest rate issue and a housing issue. So long as people are purchasing houses, companies like Home Depot and Lowe's tend to do well. The issue now is that people are pulling back because interest rates are too high for most consumers to actually be willing to purchase whatever is available in their markets. And as a result of that, Home Depot is going to likely have some softness, but they are a cyclical business. This is something that will likely rebound once interest rates are more favorable for consumers.
Sucharita, appreciate your time. Going into a big week ahead. Sucharita Kodali there, Forrester. Home Depot down this year by 13%. Things were set up so well, and I really do feel for anyone that's working in and around residential real estate right now, because things were set up so well. Yields were coming down. We were about to get some big tax refunds going into people's pockets, into their bank accounts, which would set the stage for a cyclical upswing. And then all of a sudden, get the energy shock, yields go the other way, financing costs are going north, people are spending that refund on something else, on higher energy prices, and we were about to lubricate the very stiff wheels of the housing market, and then all of a sudden things stiffened up pretty quickly.
Right now, mortgage rates, 30-year mortgage rates in the United States are at 6.36%. That is the highest level going back to September of 2025, before the Federal Reserve cut interest rates 3 times. It raises a question of what the signal it is that is being sent and how much the housing market ends up bearing the brunt of these conflicting economic cycles that are overlaid on top of each other.
And a double whammy for individuals involved in the real estate market. Contractors I've spoken to last year were concerned about tariffs. They said things like wood coming from Canada were going up. All of these home appliances were going up because of tariffs. And now this year, it's the energy story. So really, it's been challenging.
Tough for the builders, tough for Home Depot, tough for Lowe's. See it across the board. Home Depot and Lowe's down on the year so far. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Standing by, here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. New details emerging about President Trump's meeting with Chinese President Xi Jinping. China agreeing to buy at least $17 billion worth of agricultural goods annually through 2028. The Trump administration also saying the country will set up boards of trade and investment with the United States. Elon Musk says he wants to get the SpaceX IPO underway pretty soon. Sources telling us here at Bloomberg the company could file as early as this week. Musk's company is seeking to raise as much as $75 billion on a valuation of more than $2 trillion, making it the largest IPO of all time. Aaron Rai making history at the PGA Championship, becoming the first English-born player in more than a century to capture the title. Rai made 6 birdies over the last 10 holes, taking the lead for good on the 13th hole and securing a 3-shot victory. The 32-year-old finished at a 9-under par, 271. And that is your Bloomberg brief. John.
Vonnie, thank you. Do you want a cool story? More than 20 years ago, I'm on a golf course. And me and my friends, average golf players, some of them much better than me. And there is a small kid playing golf on a par 3 using something like a 3-wood or a 5-wood. And we get talking to the dad. And the dad turns around to us and he starts saying, it's about course management. He's too young to really think about hitting the green from here. I want to think about how he's going to play the hole and take it from there. Kid must have been 6, 7, 8 years old. The mechanics in the swing, though, really, really good. And we started to hear more about him in the years after that. Aaron Rai, PGA champion. Yesterday afternoon. That was that kid. How cool is that?
That is very cool. Did you get his autograph? You should have been like, if his dad is over there planning course management, I'm getting that kid's autograph.
Was he wearing 2 gloves at 6 years old?
I don't remember that. Apparently that's because of the cold. But they've got a great story, fantastic story, and I'm really, really pleased to see it. Just absolutely awesome. Up next on the program, the Iran war weighing on wallets.
The Strait of Hormuz, really all points lead back to that. Gas prices are too high because of that. So as soon as we get that straightened out, we will get back to the kitchen table issues.
Up next, we'll catch up with Francisco Blanch of Bank of America, live from New York City. You're watching Bloomberg TV. Just a bit of a turnaround in crude. Check it out. Brent down to about 109, was at 110, north of that level. Similar story on WTI, now down by about 0.4%. As you get that turn in crude, you get this turn in yields. Yields down across the curve, 10's down by a single basis point. And this move in equities, just a slight pop off the low, almost unchanged on the session, now down just about 0.2% off the back of headlines from Iran.
These are very peculiar. Tasnim is reporting that the U.S. is proposing a temporary OFAC waiver until there is a final deal, basically meaning that Iranian crude would get a waiver so they could sell in the open market. Remember, in the middle of March, the Treasury Department granted the Iranians to sell crude that was already at sea. I just find this so interesting because at the same time, Treasury Secretary Scott Bessent is giving the Europeans lip service at the G7 in Paris, telling them they want them to join in on sanctions for illicit funding and the selling of crude, et cetera. At the same time, they're going to the Iranians and saying, If this is correct, by the way, we need to talk to the White House about this. This is coming from Iranian press, but the market certainly thinks this is credible.
We have got the perfect guest around the table to talk about this. Francisco Blanch of Bank of America joined us now for more. Francisco, good morning.
Good morning, John.
You've got a decent understanding on where we are right now. How big is the deficit for the crude market at the moment?
We have a pretty large deficit. We're running around 14, 15 million barrels a day short, 14, 15% short of what we need to see for prices to stabilize, go down to $60, $70 a barrel. So it's a big gap. And obviously, measures like this will help ease market pressures. And of course, we are going into peak demand season, which makes the deficit potentially even greater. So so I think obviously, look, it's all about the Strait of Hormuz. Can it reopen soon or not? And we've been talking about this now. I guess I feel like we're into the 11th week, 12th week.
Feels like the 11th year.
The 11th year, 12th week. I don't know. I think what's interesting is I think the news over the weekend are very good news. Also, what we heard from on the agricultural side, because at first it felt like the only agricultural discussion was Rowe's seeds, but now it's actually corn and it's wheat, and all of that. I think it's kind of provide market relief. So I think it's a sign of goodwill that China wants to cooperate, and I think it's important to understand. I mean, China is the world's largest exporter. The last thing they want is to see a global recession. They need that export market.
Well, let's start with oil, and let's assume a lot of things. Let's assume nothing changes, and the existing strategy of the US is to maintain the blockade, to get Iran to suffer, because they believe we're very close to breaching storage capacity. Given the inventory draw that you're seeing globally at the moment, if I had to ask you, assuming everything else remains the same, what happens first? Tank bottoms in the West or tank tops in Iran?
I think tank tops in Iran are pretty close. Then again, we think that Iran can survive roughly with one vessel a week, a 250,000 barrels a day. That they don't really need that much money to pay their bills. On the other hand, also we've seen Iran basically shutting down exports for about 4 years after the repeal of the JCPOA initially during the Trump 1.0 administration. So I don't really think that the Iranians, because they have to shut down fields, they're necessarily, I mean they've been there before, kind of thing, right? While us in the West, the challenge is that obviously we're going to have a much more challenging summer season, right? And people are not going to be happy. So not only you're paying higher prices, but you may have availability issues, and that can be a problem.
Are we at tank bottoms anywhere in the world right now?
So some of the countries in Asia are really experiencing a lot of strain. If you're a large energy importer with a large current account deficit, say like India or others, you are running into a lot of problems, right? I mean, Japan's seen a collapse in inventories. We've seen a number of Asian countries as well in the same position. This is primarily a Pacific crisis. It's not an Atlantic crisis yet, and that's why we haven't felt as much pain in kind of Europe, U.S.
We're going into Memorial Day weekend, and AAA says that there's going to be tons of people still on the road. These gas prices aren't holding anyone back. We're seeing the highest gas prices in 4 years. At some point, do you expect the U.S. to hit $5 a gallon? At some point, Trump might own on record the highest gasoline prices, overtaking Biden.
Well, so it's hard to say. A lot of it's going to depend on some of these measures, whether you can move barrels through Hormuz or not. But ultimately, we are in a situation where, of course, the U.S. consumer is in a better position than most of the world. And remember two things, right? So first, the U.S. is a net exporter of energy. So there's companies in the U.S. making a lot of money on the back of the higher prices. So that's number one. And number two, as I said, countries around the world have, in general, lower incomes than the U.S. So U.S. consumer is a very wealthy consumer, right? The Indian consumer, on the other hand, is a whole different story, right? So the shortages are happening. They're just not happening here because of the income and because of the availability.
There was a sense when we started this, if this conflict went on for 6 weeks, it would be a problem. Then it was 8 weeks. Now we're at 80 days, and people are saying we still can manage it. And it's because the supplies from the U.S. have been more than we have previously expected. There was more supply on the sea. Are we reaching a point of a step change in prices?
We could be, I would say, almost any week, right? So there's three potential paths here. There's the peace agreement, which I think will allow us to maybe average $90 a barrel on Brent throughout the rest of the year. There is the continued ceasefire with a double blockade, which I think eventually will get us higher. And I think we'll probably be 120, 130 over the course of the next few weeks if the ceasefire doesn't end. And then if we go into late June, 4th of July, we could be well above that, right? And then there is the war escalation scenario where things can get a lot more shaky with prices going up pretty substantially. Because the most important thing, remember, is not so much how much oil is coming out of Hormuz right now, which obviously impacts prices, but how does the war impact the forward balances? That's the key, right? So if we end up seeing facilities in the Middle East being hurt again in a meaningful way because there is escalation, that's going to alter not just the gap that we have today that people expect to kind of clear out as soon as Hormuz clears out, but the future gap.
So 2 out of those 3 scenarios are significantly higher oil, significantly above $120, $130 a barrel. Why do you still have the average Brent price being $92.50 for the full year?
Well, because I think President Trump's been guiding us to that this war is almost over. That we are going to see the reopening of Hormuz, and I think that's generally what the market believes. I think the narrative has been strongly geared towards the idea that it's in everyone's interest to reopen Hormuz. And again, I mean, today we're just mentioning a small pullback. I mean, it's good news that China wants to collaborate with the U.S. and try to get the world economy back in shape again. But we are drawing from inventory. So I think there's an assumption that this is so big that ultimately the powers that be will coalesce together.
Is that news, Francisco, or speculation? Is it news that China wants to help, or is it just speculation they will?
Well, I mean, if they're buying U.S. agricultural products, presumably that's one step forward, right?
We hope they take a few more. Francisco, thank you, sir. Francisco Blanch there of Bank of America. I think everyone hopes they take a few more steps forward and help us get this thing moving again.
Right. Remember, it's the Chinese that told their firms that they can ignore and shrug off U.S. sanctions. And the president said he's going to consider maybe lifting some of those sanctions when it comes to those Chinese refineries, those teapots that buy Iranian crude. When it comes to agricultural purchases, though, this has been going on for months in terms of a sidebar discussion between the USTR and China to buy more, because that's what this whole trade war was about.
You were there. How strange was this meeting?
It was pretty strange. Yeah.
What was strange about it?
Strange are all the CEOs that just, some of them randomly last minute on a refueling stop decided to join the president. And also, I found it so odd. I mean, China obviously wants to dominate the narrative. It's on their turf. But to come out with a readout, why the principals are still in a meeting, I thought was very assertive. And I expected more pushback from the president of the United States.
Pretty incredible. Brent crude this morning, just about trimming that turnaround. We're back to about 109 on Brent. WTI at 105. Coming up, we'll catch up with Liz Thomas of SoFi. We'll talk to the Ryanair CEO, Michael O'Leary. Look out for that conversation. Veronica Clark of Citi on why they still think this Fed cuts rates this year. And Colin Martin of Charles Schwab. The third hour of Bloomberg Surveillance just around the corner.
What continues to drive the market higher here is the tech and the AI narrative.
We are starting to enter the middle game of AI.
It's not bubble-ish valuation.
This is an AI revolution. The underlying inertia right now looks like it's pretty set to continue for the foreseeable future.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Just off session lows, we're down by 0.25% on the S&P 500, negative 0.2 on the Nasdaq. Just off session highs across the yield curve, 2s, 10s and 30s, still close to multi-decade highs at the long end of the curve on 30s this morning. 5-12-20. Supported earlier on by moving crude, 110 on Brent. Just off those highs now this morning, back to 109.
Yeah, Mike Wilson over at Morgan Stanley said that this is becoming a limiting factor for the stock rally, how high oil prices are and how high rates are as a result. Going on to saying that bond markets need a lasting resolution to the Iran conflict before rates can come back. Right now, this is not about demand destruction. This is purely an inflationary story, and that's how it's being treated in the rates.
Certainly not seeing a solution at all this morning, are we? Through the Strait of Hormuz or in the Middle East. The pressure building on G7 allies to maybe ramp up sanctions on Iran. Or is it the other way around? A report from Iran just moments ago indicating it might be.
Sounds like the United States wants the Europeans to ramp up sanctions while they unwind them during what the semi-official news agency in Iran is saying during the negotiating period. The U.S. basically is offering, according to Iranian media, that they will waive the sanctions. So basically allowing Iranian crude to hit the global market. This would be a huge deal, but also not unprecedented. What did they do in the middle of March? This administration allowed just that.
Help me understand this. Are we negotiating an end to the war or negotiating the terms to negotiate an end to the war? What phase are we in right now?
Right now, we are negotiating terms to get to the negotiating table to end the war. When you get to a negotiating table, especially when it comes to things like nuclear, you're going to have nuclear scientists on each side that need to come to the table and join them. This is going to take months. And I think, obviously, bleed into next year.
Francisco Blanch put out 3 scenarios. One of them is that there's de-escalation, things get moving through the Strait of Hormuz, and you get to his call for $92.50 a barrel. The second scenario is the blockade continues, and then you end up in this zone where oil prices just creep higher. It is boiling the frog as the tank bottoms get closer and closer. And the third scenario is another hot war, which could potentially destroy facilities and cause oil prices to spike well beyond what anyone is projecting right now. You put those 3 scenarios together, it is uncomfortable heading into the driving season, as you've mentioned, and at a time where already we're seeing some of the stockpiles get depleted.
I think I can say on behalf of everyone, we all hope we avoid scenario 3. Big time. We don't want to go back to that. Crude this morning slightly elevated but off session highs. The week ahead shaping up as follows. Lots of earnings, including numbers from Nvidia. And on the consumer, this is an important read now. Away from the economic data, what are the companies seeing at the corporate level? Home Depot, Target, Walmart through this week.
Walmart in the last reading said that they were starting to see weakness around lower income consumers and that they could really feel that. Do you see that even more so now? And do you see that reflected in the likes of Target? Home Depot and Lowe's, a slightly different story given the pressure, the cyclical pressure that the housing market has been under. We keep going back to, though, how much is the Walmart of the world going to be truly a read on the consumer versus adaptation of some of the new technology and consolidation of market power?
It's a really important week as well because we're going into Memorial Day weekend, and we're at $4.51 a gallon, and this is going to be one of the highest, most expensive Memorial Day weekends American consumers are facing going back in years. So we're going to get a lot of different reads this entire week on where the American consumer is.
Look out for those earnings reports from the big retailers through the week ahead. Coming up this hour, we'll have a conversation with Liz Thomas of SoFi with stocks under pressure over the past few sessions. We'll catch up with Ryanair CEO Michael O'Leary as higher fuel costs start taking a bigger toll, and Veronica Clark of Citi on why the Fed could still cut interest rates this year. Not once, not twice, but maybe 3 times. Still the call over at Citi.
There is this belief that the economy is going to turn in a massive way, and it's going to be led by the labor market, and that's been the call over at Citi, and that's been the call at a number of other places. Overtaken by events? At what point does that end up becoming a theme?
I don't even think the president of the United States, who really wants to see interest rates cut more than anyone, I think, in the world, even agrees with that. In this Fortune magazine interview, he's saying you can't really look at the figures until the war is over, basically resigning to the fact that he may have to wait for the Fed to cut.
The 2-year just around 4.1%. In this morning's session. We begin this hour with stocks inching lower and global bond yields still near multi-decade highs as inflationary fears continue to persist. Liz Thomas of SoFi writing the fundamentals are still supportive of equities. The AI narrative is in the driver's seat, but moves in yields are finally starting to bite. Liz joins us now for more. Liz, welcome to the programme. You have described this as a risk-friendly environment. Does this bond market change things?
I think it starts to change things. I mean, we've got the 10-year well above 450 now, and that's been the level that equities have struggled with for much of this cycle. And we're seeing equities struggle with that pretty in tandem with it moving above that level for the last couple days. So I think what's happened in the last week is we obviously got some hot inflation prints last week in the form of CPI and PPI, and the equity market started to realize, okay, you know what, this war is going to last longer than we'd hoped. It's starting to show up in inflation numbers. It's likely to continue showing up in inflation numbers. The bond market responded accordingly, as did rate cut or rate hike expectations for the Fed. And now we're having a little bit of a re-rating in the equity space. That said, we still have the AI narrative. We have earnings momentum and earnings strength driving most of the bus. And that's what is keeping multiples in an elevated place at the index level. That's what's keeping risk appetite healthy, and I think these two narratives where we've got uncertainty from the war but optimism from AI are going to continue to argue with one another, and right now AI continues to win.
Is there a level at which rates crimp the spending desires of some of the big tech names?
At this point, I don't think that that's going to be a major point of contention. I don't think that they have enough debt yet. They could get there, but I don't think they have enough debt yet for that to be something that slows down CapEx. I think what you'd have to see is an economic response in the consumer in particular. And so far, we've seen consumer behavior change. So consumers are making difficult choices based on where prices are, but there hasn't been demand destruction. And you're continuing to see consumers spend on services. So travel has not suffered despite there being such a rise in airfare. Restaurant traffic has not really suffered despite rising food prices. You're seeing things like durable goods slow down. So it'll be interesting to see what Home Depot and Lowe's report this week. But we haven't seen the consumer stop spending. And I've been saying for much of this cycle, too, that the consumer keeps spending because the consumer sees a labor market that is still showing people as employed. And even in the last month, we saw labor data start to pick up a little bit. So I think begrudgingly, the consumer has held on to their spending trends. If the consumer slows down and it starts to take a bite out of earnings more broadly, then you see a capital markets hit, and then perhaps down the road, I don't think anytime soon, but down the road, then maybe a slowdown in CapEx spending. But I want to caveat that with the fact that at some point, CapEx spending, the growth in CapEx has to slow down. It can't continue at this clip. And that doesn't mean that something's broken or something's wrong.
If you do think that people are still spending and they will continue to, even with the oil prices at this rate and with bond yields where they are, then do you think that it's a good opportunity to go into the more cyclical aspects of the market, the equal weight, given that that's been underperforming pretty dramatically? Or do you want to stay with big tech as the one theme that will be the stalwart through all of this?
It's a good question. And the real question for investors right now is, if it is in fact a bubble, and if we are in fact getting towards, let's say, the middle part of that bubble, nobody knows when it will pop, if it does pop. But in the meantime, you still want to be exposed to that theme that's driving optimism in the market. So the question is, as you have exposure, as I'm going to assume most investors do, you manage your positions at this point. This is about risk management, but maintaining exposure to AI, to tech, communications, and some of those consumer discretionary names that are very AI adjacent. But making sure that as prices rise, you're starting to trim that and manage your exposure to particular names or particular groups, right now the semiconductors, for example, and then taking that capital and redeploying it into areas that I think are set to benefit from AI, but just haven't yet to the same degree. And healthcare would be a place where I would put some of that capital.
Healthcare continues to come up. What other sectors are potentially going to be the first ones to win this race in terms of the benefits from AI?
Well, I think some of the larger sectors like industrials can. Over time, I think healthcare actually ends up being the largest beneficiary. Now, it'll take a while, but I think some of those larger sectors, as I mentioned, industrials, hopefully financials as well. But right now, the cyclicality ratios outside of tech aren't really showing that strength yet. We've got this momentum factor that's really driving everything, but it's not reaching into other sectors. So the broadness that we think we saw earlier before the war has not returned yet. And I'd like to see some of those cyclicality ratios pick back up. So things like consumer discretionary versus staples, banks versus utilities. I'd like to see some life out of those. Transportation come back before I would really deploy into the cyclical areas of this market.
Liz, good to see you. As always, Liz Thomas there of SoFi. That last note is really important. That's the debate right now. Do you catch up or do you catch down? Jonathan Krinsky of BTIG, semis are likely to catch down to the rest of the market as opposed to the other way around. Now, he's a technical strategist, and I have to say, my words, not his, he sounds super bearish right now, just going through his coverage of things over the last week.
Yeah, he's been incredibly bearish in terms of the equal and opposite reaction of what we've seen in terms of a hyperbolic move. He cited Eminem. Oh, there goes gravity when he was talking about what he expects. But at a certain point, you start looking at this and saying, so someone is wrong, right? Either we are underestimating what AI is going to do, or we're overestimating it and this is overpriced. But if we're underestimating it, the scope of change elsewhere maybe is that much more that we have to think about.
The S&P this morning down by a little more than 0.1%. Let's get you an update on stories worldwide with your Bloomberg Brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Oil prices reversing earlier gains. Iran's semi-official news organization Tasnim reporting the U.S. is proposing a temporary waiver on Iran oil sanctions until a final agreement is made. Tasnim citing a source close to the negotiating team. A major power deal may be on the horizon. NextEra is discussing a mostly stock deal for Dominion Energy. Sources telling us here at Bloomberg the deal would value the company at about $66 billion. NextEra's shareholders would own about 75% of the combined company. And Ford shares rising in the pre-market. The car maker announcing a 5-year framework agreement with EDF for battery storage systems. The deal could lead to up to 20 gigawatt hours of power to support grid resilience across North America. And that is your Bloomberg Brief. John.
Vonnie, thank you. That name has become one to watch. Up in a pre-market by 6%. Up next, the morning calls, plus the Ryanair CEO, Michael O'Leary, as higher fuel costs begin to bite in the industry. An absolute legend of that industry joins us next in the studio. Looking forward to that from New York City this morning. Good morning.
Interested in what's going to happen on a go-forward basis. I think we know Jensen. We know that he's very skilled right now. He's likely to get that $6 trillion valuation because the market wants it probably almost more than he does. We are seeing a weakening in the overall AI story, and they are a huge chapter of that story.
That was Sarah Kunst of Cleo Capital on the programme a little bit earlier on, going into earnings from Nvidia. Those numbers drop on Wednesday after the close. Ahead of the opening bell later on this morning, about an hour and 15 minutes away. Equity futures slightly lower, down by 0.2% on the S&P. On the Nasdaq 100, down by a tenth, coming off the back of the biggest biggest one-day drop we've seen in the last month, going all the way back to March 30th. Some negative follow-through, just trimming the losses in the last hour. In the bond market, yields still elevated, very close to multi-decade highs. The 30-year around 5.12, supported by this move in crude. Brent, the front end of the futures contracts, 110 earlier on this morning, 109.65.
Yeah, the idea that it was able to shake off that one report gives you a sense of the path of travel. This is boiling the frog. We keep repeating that over and over again as the blockade remains closed for 80 days.
Keeping with that blockade, and it doesn't seem like things are going to change anytime soon.
No, but it's very interesting that the Iranian media is reporting that part of the negotiating process was that the United States would give some OFAC waivers, basically allow Iranian crude to be shipped. This would just get to the table, basically as maybe an olive branch of goodwill to start the process to wind down this war. Very interesting, though, because the Treasury Secretary is telling the Europeans they need to up the sanctions. Yeah, so they're kind of talking about both sides of their mouth. We obviously need the White House to clarify.
That's how the stage is set in the commodity market. Let's get you some morning calls. First up, KeyBank raising its price target on Nvidia ahead of earnings, expecting higher shipments of the company's most advanced chips. Your second call from Bernstein initiating coverage of ARM with an outperform rating, saying the company will benefit from a renaissance for CPUs. And finally, Citi raising its price target on Intel to 130, seeing the CPU market growing 35% annually in an updated model. That stock is just inching higher by 0.1%. Elsewhere, let's talk about Ryanair. Shares rising after posting a record full-year profit. The budget carrier warning of rising costs this year from, guess what? Higher fuel prices. Joining us now, legend of the industry, the Ryanair boss, Michael O'Leary. Michael, good morning. Good to see you. Come on, we've been friends for a while.
You're a legend.
Fart of the industry.
How would you describe yourself? Old fart?
Old fart, I think, yeah.
I think it's fair to say.
Aging dinosaur.
You've seen it all, sir. Have you seen something like this before, the situation?
About 5 years ago, the Russians invaded Ukraine. 20 years ago, the second Gulf War, the first Gulf War, 9/11. Yeah, this happens regularly within our industry. That's why in Ryanair, we typically hedge 80% of our fuel. We're 80% hedged out to March 27, $67 a barrel. We're in great shape, apart from the fact our share price has tanked in the last 2 weeks because they're an airline, oh, God to hell. We've just reported record full-year results, 208 million passengers, 2.26 billion euros profit after tax, spitting off cash to shareholders, share buybacks. And with a bit of luck, if this continues, although we can all have a debate how long we think this will continue in the Middle East and with the Straits of Hormuz. Some of the flaky competitors in Europe will get taken out in carrier baskets by about September, October, because they're not hedged on oil and they're borrowed up to their eyeballs in net debt.
Are you ready to buy?
We are certainly ready to buy cheap aircraft. If anybody's got any cheap aircraft, I'm really excited. We are about to get the first 10 of our MAX 10 aircraft, first 15 of our MAX 10 aircraft from Boeing in the spring of 2027. 20% more seats per plane, burns 20% less oil. Like, the technological efficiency of the new engines is remarkable. And we will take, we've ordered 300 of those from Boeing. We priced them during COVID, so we've basically stolen them. And they will transform even our operating economics in Europe for the next decade.
So are you interested, though, in buying a carrier in its entirety, aside from just their aircraft?
There is nothing in Europe you would want to buy. It's all crap. It will go bust, in the not too distant future. Europe is inexorably, moving the same direction the US did 20 years ago. 3 large connecting carriers, BA, Lufthansa, Air France, KLM, they are making out like bandits at the moment because all the long-haul connecting traffic has switched off the Gulf carriers and is going on those legacy guys. Short-haul, Ryanair will continue to dominate the short-haul space in Europe because we have much lower fares and much lower costs. We're the only really low-fare, low-cost carrier in Europe. There's a few other low-fare, not-so-low-cost carriers in Europe, but they're all good too. They're all going to go the same way as Spirit and Frontier in the States.
That's what I wanted to ask. It seems like the model in the U.S. is really struggling. We had Spirit go bankrupt. There's talk of mass consolidation among some of the other low-cost carriers, and this idea that every consumer is expecting higher quality and that is what's generating a lot of the revenues. How does Ryanair succeed in that environment, in that demand backdrop?
I mean, the problem for the last 20 years in the States is there's really been no low-cost carriers anymore. I mean, we copied out this formula originally from Southwest back in the late 1980s when Herb Kelleher was in his pomp. Southwest were charging $10 fares. Now Southwest's average fare last year was $140. It's not a low-fare carrier anymore. If you had a real low-fare carrier here in the States, as Ryanair is in the US, our average fare last year was $40. There would still be very strong demand because the main airlines here, I mean, they've had control of supply in the market for the last 20 years and they've been pricing up. The cost of air travel in the States is incredibly high, particularly given that you don't pay for ATC.
Could you expand into the US?
No, absolutely not. We're too busy expanding in Europe and in those countries around Europe. There is so much growth available to us in Europe. You look at it, last year we grew 4%. We're the biggest airline in Europe. We grew 4% to 208 million passengers. This year I'll grow another 4%, 216 million passengers. And in the next decade, with these MAX 10 aircraft, I'm going to grow to 300 million passengers, all in Europe. I mean, Europe is the best playground for a low-cost airline that you could possibly imagine. A couple of big, useless legacy airlines charging more, charging annual salaries for their long-haul travel, but nobody able to do the low-cost stuff. We do the low-cost stuff well. We're cheap Irish guys, and so we do it well with with an order for 300 really fantastic aircraft coming from Boeing.
You used to be so mean back in the 90s.
Which?
Used to be so mean. It was brutal. Do you remember that?
Yeah.
Well, we were never brutal.
Tough.
We were cheap and we were cheap and mean. Now we're just cheap and cheerful. New aircraft, on-time flights. Huge. I mean, last year we were record customer service metrics. Customer service satisfaction went up from 86 to 89%. I never thought I'd see the day when I got more than 50% customer satisfaction. But hey, who knew?
Can I ask you, where are Europeans traveling to this summer for vacation? Do they want to come to America anymore?
No. I mean, sorry, that's not true. Yes, they do. But the problem is that the cost of long-haul travel has got very expensive. So there isn't much competition across the Atlantic between the European legacies and the US majors. The Gulf carriers were the real disruptors for the last 20 years, and they have, their capacity's been halved in recent months. So a huge amount of Europeans will holiday at home in Europe this year, in Portugal, in Spain, in Italy, in Greece. A lot of Americans are still coming to Europe, for the quality, for the sunshine, the culture, and the alcohol, and long may they continue to travel. But I think there's a real sea change this year of people who would historically have gone to the Middle East or using the Middle East carriers to connect to long haul, probably going to stay at home in Europe this summer.
When will Europe run out of fuel?
Jet
fuel.
It won't. There was a real concern, I think, back in April. There was real worries over supply, jet supply. The jet supply has now, and we met with all of our fuel suppliers in Paris last week, there's no issues over jet fuel supply right now through till the end of September. There's one issue in the UK Q8, which is the subsidiary of the state of Kuwait, have about 30% market share of some of the airports in the UK. Even they now are resourcing that supply. Most of Europe's Jet A1 supply comes from West Africa, the Americas, Norway, and the lifting of Russian sanctions has also eased the supply of Jet 1 into Eastern European countries.
So you don't seem concerned with what's going on right now with the conflict in Iran?
I'm very concerned about the price of oil. But I don't believe the conflict in Iran will have any disruption on European jet supplies. The question for us is, how long will the Straits of Hormuz remain closed? I mean, you know, we gave guidance this morning. If it remains closed till March 2027, our unit, because of our unhedged 20%, our unit cost might rise, you know, mid-single digits this year. Nobody believes.
What are you hedged out to? Can you just explain your current hedging strategy? What are you hedged out to?
Jet fuel. We have bought 80% of our jet fuel requirements, John, out to March 2027 at $67 a barrel. So we're sitting, you know, we're in great shape. Great position. But nobody really believes that the Straits of Hormuz are going to stay closed until March of next year. It's just we don't know when they're going to reopen. Iran is going to starve if they don't get it ready. You know, the Straits of Hormuz reopened in the next couple of months. The midterm election season kicks off on Memorial Day at the end of May. You know, Trump is going to lose the House and the Senate if he doesn't get this resolved and reopened. But the timing is, none of us know when the timing will be. But, you know, I hope it's sooner rather than later. But if it becomes later, say it's, you know, if something happens that none of us expect, the Straits stay closed till September, October, November, then we are looking at, our unit costs will be up about 5%, but you'll be looking at kind of airlines failing all over Europe on the way out of the
Who's
summer.
failing?
Well, I can't really name them, but, you know, some of our low fare but not so low cost competitors.
EasyJet, Wizz?
I don't think EasyJet will fail. I mean, I don't think they'll make any money this year. Wizz could well be a candidate for failure. Air Baltic, which was recently bailed out by the Latvian government, gave it a 30 million loan to get them from June through to August. But they have to repay the loan in August. I mean, good luck with the Latvians trying to get that repaid at the end of August. So I think there will be casualties. But again, a lot depends on how, I mean, you know more about this than I, how long the Straits of Hormuz remain closed. When can Trump declare a victory and, you know, kick off the midterms? And I suspect it's probably going to be the end of May, maybe early June. But what the hell? I mean, if my predictions were any good, I wouldn't be working in the airline business.
Doing something
I'd be working in a proper functioning business like Bloomberg.
I'll get it right this time.
With your rock star salaries.
I'll get it right this time. Michael O'Leary, old fart of the airline industry, boss of Ryanair. Michael, good to see you, buddy. Thank you.
Good to see you, John.
Thank
and
you.
ladies, thank you.
Up next, Veronica Clark of Citi. Michael O'Leary should just guest host the programme. Maybe you just host the programme.
I was about to say, you can take my
watch.
side.
Everyone's messaging. This guy's hilarious.
I'm humble enough to say he'd do better.
I'd happily watch that programme. Equity futures on the S&P this morning, firmer by 0.1%. Off the lows, we're still negative by 0.15%. On the Nasdaq this morning, we're down by 0.1%. On the Russell, negative by 0.1. Things have turned around in the last 90 minutes or so. With this move in the bond market off the highs, yields at the moment on 30s, 512.82, still up a single basis point, 10 still around 460. Bit of an unwinding crude as we came into work this morning here in New York around what, 4 a.m., 5 a.m. That's sad, isn't it? Brent crude was north of 110. 109.42, 43-ish right now, up by 0.1%. Some news coming out of Iran that maybe the US is prepared to do something on sanction waivers to get talks going again, which is hard to get your head around.
A temporary waiver on Iranian oil sanctions until there is a final agreement, which how long could this final agreement take? So basically a way to push the Iranians to the table. Potentially, this is coming out of Iranian state media. I find it just fascinating because it's mere hours after the Treasury Secretary in Paris at the G7 finance ministers meeting is giving the Europeans a little bit of a smackdown about how they need to be tougher on Iran when it comes to sanctions, when already this administration in March gave a waiver for Iranian oil at sea. So, talking out of both sides of their mouth.
You said it earlier on, are we negotiating terms to end the war or negotiating terms for negotiations to end the war? And it feels like we're in a much, much earlier phase of negotiations based on some of the evidence we're seeing so far.
Yeah, where's the progress? And ultimately, people aren't seeing it, which is why the blockade has gone for 80 days and why people don't see an end to it. That was the sea change over the weekend, is that China's not going to stop it, and people aren't seeing the exact end other than either an escalation or some sort of sea change that we haven't just seen yet.
What a difficult moment for the incoming Fed chair, Kevin Walsh. Yields at multi-decade highs. Energy at multi-year highs. Pressure building to cut interest rates from the president at least, and maybe that has cooled off somewhat. And a committee that's very, very fractured. That's a difficult meeting a month away.
I think it would be a good time to get laryngitis. I think just say, honestly...
Right, can't do the presser.
It's really tough, I'm sorry.
Havanta virus.
That's something else. Don't wish that on anyone. Don't wish that on anyone.
Well, then he really can't show up, though. Right. That's all I'm saying.
Okay. That news conference a month away with Kevin Warsh. Policymakers facing a growing divide of the Fed's approach to interest rates. Wednesday's FOMC minutes expected to show divergence over the central bank's easing bias as the Fed prepares to enter a new era. Bloomberg's Enda Curran joins us now for more. Enda, welcome to the programme. Kevin Warsh, at a really difficult moment. Just how divided is this committee?
Well, I think the minutes on Wednesday will reinforce how divided the committee is and how difficult it will be for Mr. Warsh, John. Like you say, we know at the last policy meeting there were 3 dissents over the language in the statement itself. That was, and when you include Governor Myron's dissent against the decision, it was the most dissent since 1992. The point is that the Fed policymakers are trying to move away from this idea at all that the next move in rates might be a cut. They want a message getting out there now that, number one, at the very least, they're on hold. For as long as, for the near term to medium term at least. And then beyond that, we might get a hint from the minutes in terms of just how hawkish some people are. I mean, nobody yet is saying a rate hike is their base case, but certainly it's starting to come into market pricing. We're starting to hear policymakers warn about it. Governor Berro last week saying his biggest concern at the moment is that inflation won't behave, for example. So when we get these minutes on Wednesday, it will just reinforce, A, the Fed is not cutting near term. They're on hold. It will then, though, spark a conversation about what might just tip them over the edge towards the hiking territory that other central banks are in.
And do you sense that the pressure is coming down just a bit? And I'm talking about the pressure coming from the White House and the president. Annmarie talked about an interview conducted, released overnight, just showing the president maybe understanding why they wouldn't cut interest rates through this summer. I've heard similar noise coming from the likes of Secretary Besson, from the NEC director as well, that maybe they've just dialed down the pressure just a touch.
It's a really interesting observation, John, and I think it's one that everybody's going to be watching closely. I mean, we have had mixed signals on that, though. If you remember, maybe a month or two ago, Treasury Secretary Besson was making the point he would understand why the Fed would be on hold. But then you have people like the NEC director, Kevin Hassett, saying there's plenty of scope for the Fed to be cutting rates. And at one point, of course, President Trump as well said he would be disappointed if they don't cut rates. But I do think it will be very interesting to see if, once Mr. Warsh is sworn into office at some point soon, if the language does change critically from the top down. I think if President Trump consistently starts saying, look, we're in a situation now with yields where they are and with oil prices where they are, etc., that the Fed needs some time out, well, obviously that will be a very important observation to keep an eye on. But I don't think we're there yet, John. It seems to be mixed signals from the administration at the moment.
Enda, thank you, buddy. It's good to hear from you. As always, Enda Curran down in Washington, D.C. Can this Fed cut rates? Not once, not twice, but maybe 3 times this year. Veronica Clark of Citi thinks so. Gradual weakening in demand will lead to a rising unemployment rate in the summer months. Veronica joins us now for more. Veronica, good morning.
Good morning.
Each passing day, this sounds more and more contrarian. Just lay out your argument for us.
No, it definitely, to get 75 basis points cuts, to get any cuts at all, it does have to start with the labor market data, right? And right now, nothing really looks like it's breaking in the labor market. We even had a stronger jobs report last month. I would take the payroll numbers with a bit of caution. They are very volatile now. And I'm not really encouraged by what you see in the unemployment rate. We've had this big slowing in labor supply. Labor force participation rate has come down, and the unemployment rate is still stuck at 4.3, 4.4%. That means that demand got worse. And that's ahead of the summer months when you usually hire a lot of people, when you get students entering the labor force, new graduates. And it's been the summer when we've seen the unemployment rate rise the last couple of years. There's a reason the Fed has cut in September for the last 2 years. It's when we see the summer data.
You've got unemployment going up then?
Yeah.
Where have you got inflation?
It needs to look better, right? So the inflation focus right now, it's still uncomfortable, right? So even the May data, I think, will look uncomfortably strong. But I think if we see monthly inflation readings for June, July, August, data that we'll have before that September meeting, if those monthly reports look better, annual inflation will still be high. But you do need inflation, at least on a monthly basis, slowing for the Fed to be comfortable cutting.
What would you have to see to change your view?
stickier inflation for longer, not seeing the seasonality in the labor market data. Really within the next couple weeks, that seasonality starts to first play out in initial jobless claims. Once you get around the start of the summer, Memorial Day holiday, around mid-May, certainly by June, you do see claims starting to trend higher. So that's the first thing I'm watching for. If that doesn't happen within the next month or two, then okay, maybe the labor market has durably gotten better. Yeah.
Isn't there a bit of a stress on this entire equation because it might not be as hinged to the labor market as it has been in the past, that inflation could be stickier even without the participation of the labor economy, just based on all the spending coming from hyperscalers?
Yeah, I mean, I'm certainly worried about that AI-related inflation. That actually does get, a big weight in core PCE, some of those computer software-related components. So yeah, we are getting inflation there, but the demand-driven, tight labor market kind of inflation that the Fed would be most reactive to, that's what we really don't see. And I do wonder if having the dual mandate kind of forces them into caring about that kind of inflation. Even last week, we got an update for the Atlanta Fed wage tracker. That's like the monthly proxy for an ECI, Fed's preferred wage measure. It's very low again. It fell a lot. So you definitely don't see that labor market tightness kind of inflation.
Do you think that this Fed is going to have to tacitly accept 3% inflation in order to continue on the path that you see?
Yeah, I mean, on an annual basis, core PCE is going to look more like 3 for most of this year, right? I think most officials will be really cautious on that for now. But it was interesting to hear, new incoming Chair Warsh talk about other measures of inflation, right? The trimmed mean PCE, even CPI is running softer than core PCE right now. Maybe they can, adjust a little bit in what they're caring about.
The president thinks potentially you need to wait until there's the proper figures, look at them after the war is over, almost signaling that he will give Kevin Warsh a bit more of breathing space. So when would these 3 cuts actually happen?
Yeah, well, it would happen later in the year after if we see the weaker labor market data. But yeah, for right now, I don't expect that he can be particularly dovish going into that June meeting, especially if markets perceive that we're not taking inflation seriously, then it's, we get yields higher.
John has brought up a lot that this is the man who said in his Senate hearing, inflation is a choice. So how hawkish do you think verbally he's going to be?
Yeah, I don't know. It's really tricky. He's definitely been more hawkish when it comes to things like the balance sheet and trying to offset that with sounding more dovish on policy rates. But it is really hard to know what his views are going to be coming in. He is more traditionally hawkish. Is there going to be, 180? I don't think so. But yeah, we'll have to see.
Initially, inflation as a choice sounded hawkish, and then in the actual hearing, it started to sound increasingly dovish because you get to choose your index.
Yeah, exactly. Yeah, yeah. We don't really know where this is going to go. Yeah, we have not heard.
The optics aren't great, are they? They've missed their target for 5 years, and they're talking about changing their preferred index.
I don't think they will.
Time is not good.
Yeah, I don't think other Fed officials are going to be comfortable with that. But I mean, it is an interesting signal that what you are supposed to care about is the strongest of the core inflation measures right now.
I was reading some research from BNP Paribas, and they've got a different view on things for the path ahead. Everyone's entitled to their own forecast, of course. They think on the hike and the way you discuss the potential for one is to start reflecting on the insurance cuts you took a year ago and the year before and emphasise that they were just insurance cuts and talk about taking them back.
Yeah.
What would you think of that kind of move?
I mean, the market's already done that a little bit, right? And I think most Fed officials will still see that rates are on the restrictive side of a neutral range. So if you do start to see any wobbles in the labor market, then suddenly you don't need rates even more restrictive, of course, right? And I would kind of agree with that restrictive assessment just because of what we see in all the wage growth slowing, home prices that are pretty weak. Yeah, we'll see.
How messy is the SEP going to be next month?
Oh, yeah, pretty messy. Maybe at some point we even get some changes to it, right? Warsh was talking about scaling back some communications potentially. Maybe that's an easy out, right? You just say very little in June.
Veronica Clark of Citi. Veronica, thank you. 1 cut, 2 cuts, 3 cuts for the year ahead. And a base case is that you get those 3 cuts because unemployment goes higher. The view from Citi this morning.
This is the idea that the economy is going to ultimately matter. I'm sorry to sound a little skeptical here, but it's we've talked about the 2-speed economy. You have essentially rank and file individuals who are not seeing their pay increases that are necessarily matching, offsetting inflation. At the same time that you have price-insensitive buyers on the side of AI, and potentially If you cut rates, that only fuels what some people are seeing as elevated valuations or bubble-like conditions over in the one side, even as it helps some of the people on the other side.
Let's acknowledge what the market is pricing, the risk of a rate hike. But I also think we should highlight what we're hearing from the so-called hawks on the Federal Reserve. And let's take Neil Kashkari, for instance. Listening to his dissent, it sounded like his dissent was more of a performative communication exercise than it was really a display or willingness to hike interest rates anytime soon. What he was talking about was removing the easing bias so that financial conditions would tighten so they wouldn't have to do more later. I still sense a reluctance from many of these officials, even those that want to remove the easing bias of the Federal Reserve, a real reluctance to really hike interest rates.
This is why a lot of different bond investors say it's not going to happen. So stop even pricing that in, because that's an unlikely outcome. That said, if they don't remove that easing bias, and this is what Ed Yardeni was talking about,
then you've got a problem.
Then you've got a problem. And then you potentially leave long end rates unmoored. So how much does this market have to believe them that they are willing to do that in order to get long end rates under control? It's this whole kind of kabuki theater experience.
The communication theatre, right? Communication exercise. That's where we're at. Futures right now, the S&P 500 just turning positive going into the opening bell. Let's get you an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. A little more context around that Ed Yardeni call. Ed Yardeni out with a warning for the Fed catch up with bond markets or risk losing control of borrowing costs. Yardeni says the Fed should remove its easing bias at its June meeting, given that it is, quote, no longer appropriate in the current market environment. President Trump warning that the clock is ticking for Iran. The two sides are still far apart in any deal to end their war and reopen the Strait of Hormuz. In a Truth Social post, Trump said Iran better get moving or, quote, there won't be anything left of them. The nation's largest commuter railroad coming to a halt. Long Island Railroad workers striking for the first time in 30 years. The MTA is advising people to work from home if possible, with free shuttle buses and helicopter rides available as alternatives. And that is your Bloomberg brief. John.
It's the kind of New York conversation, and Vonnie, thank you. The kind of New York conversation that Mum Downey would seize on, right? That we have a problem with the train and we start talking about helicopters as an alternative.
Fair point, especially
right.
Given the fact that, yes, Blade is saying $95. Some people have done market research and found that it's actually in practice about $2,000. That said, it does highlight the necessity for us to have public transportation that is financed fully and that, frankly, is also affordable, because that also is a problem with respect to the budget.
Helicopters aren't really an alternative. You know, when I first heard 95 and I said that's reasonable for a helicopter, I don't think 95 is reasonable for many other people.
I almost want to do it just for, like, the joyride, because, helicopters are cool.
You should bill it to work expensive.
Yes.
Film it or something like that. Just a suggestion. Clear it with management first. Up next, Colin Martin and Charles Schwab with global bond yields near their highest in decades. Their conversation up next.
Nobody really believes that the Straits of Hormuz is going to stay closed until March of next year. It's just we don't know when they're going to reopen. Iran is going to starve if they don't get it ready, the Straits of Hormuz reopened in the next couple of months. Trump is going to lose the House and the Senate if he doesn't get this resolved and reopened.
Bloomberg TV anchor Michael O'Leary there. Ryanair boss could be an anchor. It's fantastic, fantastic. A little bit earlier on the airline industry and the situation in the Middle East. Let's talk about that situation, because equities are turning around just a bit. We're positive by 0.2% on the S&P, up by 0.5% on the Nasdaq. The why? Some of that is in the bond market. Earlier on today, we were at 112 and positive 2.5%. And now in the commodity market, we are down by about 1.5% at 107. So Brent crude down to 107 from 112. That's a 4-5 percentage point trading range already, so near session lows, taking bond yields a little bit lower compared to where they were, 2s, 10s and 30s. So getting some support from fixed income and commodities off the back of some headlines in Iran from about an hour, 2 hours ago.
Saying that the United States is proposing a temporary waiver on Iranian oil in the middle of this negotiating period, which would mean we could see more Iranian oil hit markets. It's very interesting. Want to see the United States, what the White House has to say about this, the credibility of this report. But would it show that behind the scenes, maybe there are more olive branches the U.S. is willing to extend? But you have to think they're in a very difficult spot, especially going to Memorial Day weekend with $4 $4.50 a gallon.
This market's just itching to fade this story, isn't it? Just any time you get a headline, it's just itching to move on.
Look through the geopolitics, always. This is the problem, though. We aren't moving on. It's been 80 days, and Mike Wilson is saying that ultimately the fate of the rates market is going to rise and fall on the Strait of Hormuz. And right now, given the levels that we're at, so too go risk assets.
Week ahead looks like this right now. Heading into all of that, we're going to get this. The G7 finance ministers meeting in Paris taking place today with some pressure, according to Secretary Bessent, that he wants them to ramp up their sanctions on Iran.
Lip service to the Europeans.
As we get headlines out of Iran suggesting completely the opposite anyway. Through the week, also lots of Fed speak, tons of earnings too. Nvidia on Wednesday. We get Walmart on Thursday. Target, Home Depot in the mix as well. So look out for all of that. In the bond market, multi-decade highs and long-end yields coming into this trading week. The 30-year at 5.10 stateside. Colin Martin of Schwab writing the sell-off is driven by a confluence of factors, including oil prices, inflation, and shifting Fed expectations. An extended pause on rates is our base case. Colin joins us now for more. Colin, good morning. Good to see you.
Good to see you.
I'm going to throw this quote at you. It comes from Torsten Slock of Apollo. He says, renewed inflationary pressure, large government deficits, the end of QE, increased geopolitical fragmentation. He thinks that means rates will stay higher for longer. Investors should plan accordingly. Do you agree?
Yeah, that sounds about right. You know, our case right now is for the 10-year yield to kind of stay in a range. We probably think there's probably more upside than downside, but we don't see too many factors that are going to pull Treasury yields significantly lower anytime soon. To get the 10-year back to, say, 4% or so, we need to see much slower growth, recessionary risks rise, and that's really not the case right now. And with the Fed on what we're calling an extended pause, you know, two-sided risks, who knows where we'll be in the next, say, 9 months, 12 months, but the case can certainly be made. One thing that you said there that Slock mentioned is, you know, term premium, QE, balance sheet things. The term premium is something that we've been focusing on. We're still at a relatively low level. I know it's a hypothetical thing we're talking about here, but when you look at historical term premiums in periods when inflation was higher, more inflation volatility, uncertainty, and the no use of a balance sheet, one could argue that the term premium should be a little bit higher now. So that's a little bit more upside pressure on long-term yields.
What numbers will we struggle to live with? That's what I'm trying to work out. At what point does the bond market sell-off become self-limiting? Closer to 5%, something north of that? When does that start to bite for you?
You know, probably 5% or so. We've long held that 5% as that kind of psychological level, at least from an investor standpoint. If the yield touches 5% on the 10-year, we probably see some buyers probably jump in. At what level does it become of a risk for borrowers or businesses? It's probably close to 5% also. We do worry a little bit, even though there's a lot of complacency in the credit markets right now. A lot of businesses were probably planning for slightly lower rates. How much lower? Obviously, that varies, but they're seeing the opposite right now. So anyone who's been planning issuance, refinancing, all the hyperscalers with their issuance, we're seeing higher yields right now. We do think that's a risk. One concern, though, on the what's the level where, you know, maybe investor demand comes in. We saw the 30-year auction last year, the 5% handle. Wasn't the best auction. It wasn't terrible, but it came in, it tailed a little bit, and it was the first, 5% handle on a 30-year since 2007, I think. And it's not like we saw a lot of demand jump in there.
Are you concerned about the non-tech issuers in the credit market, given the fact that you've got mass crowding out when it comes to the hyperscalers issuing billions of dollars of debt, the Treasury issuing billions of dollars of debt and offering yields that actually are giving people some income?
Yeah, so worried about that investors might not be too interested in lending to them because there's everything out there? Not really. We're okay with most of the non-tech, IG space at least. Credit quality is really strong. There still appears to be a lot of demand, and the demand keeps picking up. I mean, the numbers we're seeing really are staggering. But from a fundamental standpoint, especially non-tech, we're looking at improving credit quality in IG. I mean, we're seeing AAAs get upgraded to single A space. So I think the spreads you're seeing, yes, they're low, but I think they're indicative of a resilient economy and companies with strong fundamentals.
The resilience of this market questions how we're possibly restrictive. Is this a restrictive rate? If the economy seems to be humming along, if you're seeing issuance go to record levels, and if you see performance continue to withstand without some sort of huge surge in defaults?
Yeah, it's probably not very restrictive then. I mean, neutral at best, maybe a little bit accommodative. I mean, this has been our thought for a while. Even if we go back prior to the spike in oil, you can look at any number of things in the economy and we'd say, why do we need to be talking about rate cuts right now? And we were projecting rate cuts, only one or two, prior to the conflict, on our, on the trend of inflation moving gradually lower. But when we look at where we stand right now, that's not really the case. The stock market continues to hit all-time highs. Credit spreads are very low. Consumer sentiment is down, but we're not seeing it in spending numbers just yet. So arguably, we are not restrictive right now.
The Fed just moves so slowly. If you think back to the experience coming out of the pandemic, it took them months to even begin talking about winding down QE, and then months to wind down QE before they could really start talking about hiking interest rates. And it's that I think is sort of paralysing them right now. That maybe the leadership of the Fed felt like it was too soon just to adjust just a few words in a statement. That's really what this so-called easing bias is. It's a few words. And if you asked anyone outside our industry to find them, they wouldn't know what to point to in the statement that actually articulates the easing bias. It's that vague.
Well, that said, if this is not a Fed that drops the easing bias come June, how much does the market push back massively?
That's the
because
problem
right
they've
now,
got.
the market is screaming, please drop the easing bias. Acknowledge what we're telling you, which is that inflation is presenting you with a very complicated and difficult situation.
They're stuck between a rock and a hard place. If they talk about hikes of the ECB, we're talking about a hawkish policy mistake. If they talk about maintaining an easing bias of the Federal Reserve, they anchor front-end rates, they leave the long end vulnerable, we start talking about a dovish mistake at the Federal Reserve. There's no winning this summer until this issue is sorted out in the Middle East.
Yeah, and that's the reason why a lot of people are saying until that is sorted, this is going to be persistent pressure pretty much globally. And that's the reason why rates continue to climb higher in the face of higher oil prices, even though in the past they've been self-limiting.
Colin, it's good to see you. Thank you, sir. Colin Martin there of Charles Schwab. It's a bond market without any anchors at the moment, without a solution in the Middle East. We used to have anchors. We used to have what was called the Japanese government bond market and the German debt market, and they just used to sit there holding yields down, and those anchors have been away for a long time now.
People are contemplating a new inflationary era where suddenly we have to build things. And that is a very different proposition where income isn't enough to get the job done.
Futures positive. Let's see if these gains hold. We're up by 0.2% on the S&P 500 from New York City this morning. Good morning to you all. Thank you very much for choosing Bloomberg TV. Looking forward to covering the week with you. This was Bloomberg Surveillance.